Under surveillance this morning, Trump versus Powell.
Our independence is a matter of law. Fed independence has pretty broad support across both political parties. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress, where it really matters. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors. We're never going to be influenced by any political pressure.
So here's the latest this morning. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Bloomberg's Tyler Kendall joins us now for the latest. Tyler, what do you make of that one?
Yeah, hey, John. Well, while President Trump has long been critical of Jerome Powell, this does appear to be an escalation. Of course, big interpretation questions, though, is President Trump pointing to the end of Powell's term as chair in 20...
everyone, good morning, good afternoon, good evening to all of you. आज है 18th of April 2025. Happy holiday to all of you. Long weekend there. आज फ्राइडे है, मार्केट हॉलीडे है. इंडियन मार्केट NSE BSE completely closed. MCX मार्केट, कमोडिटी मार्केट जो हम कहते हैं, वो भी क्लोज है. मॉर्निंग और इवनिंग सेशन दोनों ही बंद है. फॉरेक्स मार्केट भी क्लोज है आज, ठीक है. फॉरेक्स मार्केट भी क्लोज है, तो गोल्ड, सिल्वर या फिर जो भी आप ट्रेड करते हैं फॉरेक्स में, कुछ नहीं चलने वाला. ऑल क्लोज्ड. क्रिप्टो आज मार्केट ओपन है, तो सोचा क्रिप्टो कर लेते हैं. एंड ये एक चार्ट लगा हुआ है बिटकॉइन का और दूसरा है इथेरियम का 15 मिनट टाइम फ्रेम पे. लेट्स सी कुछ अगर ट्रेड बनते हैं तो. बाकी देखेंगे, ठीक है. कोई क्वेश्चन होगा तो पूछ लेना अगर क्रिप्टो में ट्रेड करते हो. अगर नहीं करते हो तो फिर हॉलीडे बनाओ 3 दिन का. बाकी कल करेंगे वीकली एनालिसिस एंड देन वी विल मीट इन मंडे फॉर निफ्टी बैंक निफ्टी एनालिसिस. लेट्स सी. And कोई डेटा भी नहीं है. There is no data scheduled for today. Bank holiday in Britain and there is a FOMC member speech which is late night around 8:30. तो उसके अलावा और कुछ भी नहीं है मेजर डेटा जो शेड्यूल हो आज के लिए. XRP USDT 1 वीक. XRP USD वीकली तो साइडवेज ही दिख रहा है सर फिलहाल के लिए. नीचे सपोर्ट है ये FEG का, तो मार्केट वहीं पर रुक रहा है फिलहाल के लिए. ब्रेकडाउन अगर हो जाता है तो बढ़िया है 1.6 के नीचे, नहीं तो ये साइडवेज हो चुका है सपोर्ट पे. ऊपर भी जहां तक जाएगा, ऊपर एक रेजिस्टेंस था, ये यहाँ से ऑलरेडी रेजिस्टेंस लेके आ चुका है नीचे 2.7 का. तो अगर सपोर्ट लेना होगा तो जाएगा, नहीं तो ब्रेकडाउन करता है तो फिर और नीचे एक्सपेक्ट कर सकते हो. अभी तो साइडवेज ही है इस वीक. गुड मॉर्निंग शारदा प्रसाद जी. देखते हैं, ठीक है, कुछ ट्रेड अगर बिटकॉइन में बनता है या फिर वैसे अब सब जगह ही हॉलीडे है, तो देखना पड़ेगा कितना मूव आता है एक्चुअली में. मोस्टली अराउंड 12:30 के बाद ही थोड़ा बहुत मूव आएगा जहाँ तक मुझे लग रहा है. उससे पहले तो क्या ही मूव आने वाला है अभी. बाकी एक कल एक रेजिस्टेंस बताया था, वहीं से मार्केट ने रेजिस्टेंस लिया है बिटकॉइन में. कल किसी ने पूछा था ना, अपर लेवल पे यहाँ पर एक रेजिस्टेंस है बताया था. तीसरी बार आया था वहाँ पर प्राइस. एक्चुअली था साइडवेज ही ओवरऑल. नो, मार्केट इज क्लोज. ऑल मार्केट आज क्लोज टुडे. कुछ ओपन नहीं है क्रिप्टो के अलावा. सिर्फ क्रिप्टो करेंसी की ही ट्रेड कर सकते हो अगर करना चाहते हो, अदरवाइज हॉलीडे बनाओ, कोई ट्रेड मत करो, ठीक है. ऑल मार्केट्स आर क्लोज. निफ्टी बैंक निफ्टी इक्विटी मार्केट क्लोज्ड. क्रूड ऑयल, नेचुरल गैस, गोल्ड, सिल्वर क्लोज्ड. फॉरेक्स मार्केट आल्सो क्लोज्ड. ओनली क्रिप्टो करेंसी इज ओपन. ठीक है, देखते हैं कुछ लेवल मैं आपको बना देता हूँ. अगर 15 मिनट में तो ऐसे आएगा स्लोली ही. कैंडल का ध्यान रखना, बस ओपन इक्वल टू लो हाई ना हो तो चलेगा, कोई प्रॉब्लम नहीं है. लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम। इंडियन मार्केट क्लोज है, ध्यान रखना। मोमेंट स्लो, आज सभी मार्केट बंद है ना, इसलिए लॉन्ग वीकेंड। ठीक है, देखो बिटकॉइन में 15 मिनट टाइम फ्रेम पर वैसे तो ये रेजिस्टेंस ले ही लिया है इसने। वैसे मोमेंटम कम ही है फिलहाल के लिए तो अभी। फेक ब्रेकआउट देने की कोशिश की है। ठीक है, एक छोटा सा रेजिस्टेंस जोन वैसे तो ट्राई हो चुका है, फिर से आता है कैंडल ओपन इक्वल टू लो नहीं बनती है तो एक सेलिंग का प्लान रहेगा। दूसरा XRP इथीरियम है। फर्स्ट सेकंड वन इज इथीरियम। ओके, ये भी एक रेजिस्टेंस है तो काफी बड़ा रेजिस्टेंस है। टेस्ट हो गया ना ये भी, कंबाइन ही कर देता है। ये भी काफी देर से कंबाइन होके बैठा हुआ है ऊपर, रेजिस्टेंस भी। ठीक है, ऊपर जो मेजर रेजिस्टेंस था वहां से तो मार्केट काफी बार रेजिस्टेंस ले चुका है। लेट्स सी अब ये ब्रेक होता है नहीं होता, ऊपर नहीं तो रेजिस्टेंस मान के चलो इसको कंबाइन ही कर देते हैं। ठीक है, दैट इज अ स्ट्रॉन्ग रेजिस्टेंस। जब तक ये ब्रेक नहीं होगा ऊपर तो जाएगा नहीं प्राइस 88,500 के ऊपर। नीचे भी ब्रेक होने वाला है ये लगता है। ठीक है, ऊपर एक ही मेजर रेजिस्टेंस है, बाकी छोटे छोटे और भी रेजिस्टेंस बने हैं तो एक ही को कंबाइन करके लगा सकते हो। बहुत बार टेस्ट हो गया है लेवल भी। मार्केट इस लेवल पे देखोगे ना ऑलमोस्ट 4-5 बार आके होल्ड कर चुका है। अब यार थोड़ा बड़ा फॉल ही कर दे ये, तभी बेटर है, अदरवाइज ज़्यादा साइडवेज रहा तो फिर ब्रेकआउट के लिए चला जाएगा इसी सेम लेवल पे। 15 मिनट टाइम फ्रेम। 530 के अलावा फिर नीचे आता है तो फिर वो बड़ा फॉल कर जाएगा 81,000 के अराउंड 81,500 के अराउंड वहां तक आ जाए तो बेटर ही है फिर क्योंकि इतने देर से रुका हुआ है एक जंप मार के डाउन साइड पे लिक्विडिटी लेके देन मूव्ड अप साइड बाकी बीच में और भी सपोर्ट रेजिस्टेंस हैं बट देखना पड़ेगा क्या इनको होल्ड करता है अब या फिर नहीं बिकॉज काफ़ी देर से रुका हुआ है सेम ही लेवल पे
accomplish incredible things.
Where no one can ask or know where we are.
They're taking advantage of all these people from third world countries because a job is everything to them. They're sending a few $100s back to their family every month, and that's a lot more than what they were doing before.
$600 if you just got on the computers and talked. $700 to $800 if I got a single victim to actually invest. $1,000 if I got 3 victims, and so on and so forth.
And when they become good at scamming and they start to make serious money for their bosses, they get promoted. And of course, it results in the operation growing in size and scope.
In a single month, they can make up to $100 million. It's just beyond belief.
When Beard called me, I actually got him to run a few commands. He went round when the room was quiet and he typed certain things, and that downloaded something that gave me remote access to it. So this is the Rahaba residence. I can look at the wireless networks around that building, and with a little bit of Google's API technology, I verified that this is where Beard said the building was. You can see here on the left, there are applications which have the Chinese characters and so on. Although the vast majority of the workers weren't Chinese, the people who actually run the crypto scams are gangs from China. And if you go into Google Earth, about half the buildings were being used for the scams, and I guess one of the Chinese gangs must have commissioned a mobile communications van just to carry the traffic that they were using.
When the victims make an account on their platform and buy their first batch of cryptocurrency, the bosses of the place, the Chinese, he just take control from his computer.
It was a big transitional period, just a reset for myself personally. When you are married for that long, I think you forget what it was like to be single. I was sitting there for hours and hours and hours thinking about what I was going to be doing with my life. I was really just looking for an opportunity to keep myself busy. The first one was Jenny Ying, and she was from the UK, and she contacted me via WhatsApp. I didn't talk to her for very long before she handed me over to someone called Janice, who went by the hashtag Janice the receptionist. Now, Janice was really the person that I spent most of the time with. She said you would need to invest your money, and at the time it was about $200 Hong Kong, do the trades and do the training with us, and then we will provide you $290 back at the end of the training exercise, which was like a 3-step task that I completed. They sent me confirmation to my Standard Chartered bank account here in Hong Kong that I'd got $290 Hong Kong back. So I felt pretty positive about those tasks up to this point. They were saying to me then, well, that was a very simple example of what you could do. Would you like to learn more? That's when I probably made the first of my many mistakes in this process. I clicked on the most expensive one, which was $38,000 Hong Kong, and they would send back to me 42,000 Hong Kong dollars.
मार्केट क्लोज है आज, ठीक है, इसलिए अभी बिटकॉइन ही लगाया हुआ है क्रिप्टो. ओवरऑल मार्केट इज क्लोज टुडे. One is बिटकॉइन, सेकंड वन इज इथेरियम. ये 15 मिनट के लेवल हैं. चार्ट 1 आवर का लगाया, लेकिन लेवल 15 मिनट के ही हैं, कंफ्यूज मत करना.
What do you think happens to the cost profile in the next few years?
I'm going to give you a prediction that will sound counterintuitive and surprising. I think in 5 years, the total cost will be 1% of today's cost.
Wow.
So 100 times cheaper.
Wow.
Test what other trading partners should be doing. Scott Besson had said to me earlier in the week, first mover advantage. If the Japanese come out and are able to strike a deal, everyone is going to be looking to them. What were they able to extract? What kind of concessions also do they have to give in order to get this over the finish line before those 90 days are up?
Chair Powell isn't blinking. Is it fair to say the president is taking a softer tone with allies over the last week?
I think it is fair, given the fact that he joined those negotiations yesterday, came out and said, I'm going to be part of the negotiations. I believe they sat with the president himself for 50 minutes before sitting down with Scott Besson and Commerce Secretary Howard Lutnick. And then today, who do you have arriving in Washington, D.C. to try to have an olive branch, this whisper of Europe, Giorgia Meloni, the head of Italy, coming to town. She is going to try to help the European Union get over the finish line with some sort of deal for this reprieve that they're dealing with right now, these 90 days.
Some kind of deal, some kind of relief. The auto sector's looking for the same thing. What we saw yesterday in retail sales were consumers front-loading purchases, and you saw that in sales of autos as well, specifically. Purchases of autos up more than 5% in the month of March. Ford getting ready to raise prices on cars coming out of the factories as soon as May. That's how much time we've got here.
I think the issue you take with this, if you look at, say, Ford having to do this, Ford is looking at raising prices. Ford is the best positioned auto manufacturer in the United States, because some 80% of their cars are made in the U.S., and even they're saying we are unable to withstand this 25% levy, and we're going to have to look at, and all these tariffs, we're going to have to look at potentially raising these prices. It also comes at a time the president insinuated earlier this week that he may give the auto sector a reprieve. Still, corporate America is saying we don't know yet, so guess what? We're going to have to put the prices higher on consumers.
This market whipsawed right now between trade talk hopes, trade talk fears. This morning, trade talk hopes. It's frustrating, isn't it? Futures are up by about 0.75% on the S&P 500. Later on this morning at 8:30 Eastern Time, you'll have jobless claims. Before that, an ECB rate decision. So a couple of things to look for going into the long weekend. Coming up this hour, we'll catch up with Sharon Bell of Goldman Sachs as the volatility continues. Tobin Marcus of Wolf Research as Trump signals progress in trade talks. And Angelo Zeno of CFRA on the latest tech sell-off. We begin this hour with stocks rising on positive signs from US-Japan trade talks. The team over at Goldman Sachs staying somewhat cautious, writing the following. We would argue that we're in an event-driven bear market triggered by tariffs. However, it could easily morph into a cyclical bear market given growing recession risks. Goldman's Sharon Bow joins us now for more. Sharon, welcome back to the programme. Let's sit on those recession risks. Is it fair to say that they're receding over the last week, or are they still elevated from your standpoint?
I think they're still elevated. Whether they're absolutely at peak, perhaps they've receded from those peak levels when there was no scope for negotiation on these tariffs. Now that clearly has started, but they're still relatively high. I think we regard it as 45% chance of a recession in the US over this next year. That's a relatively high chance versus a standard year, and that's because of all this volatility and all this uncertainty.
This market lost a lot of confidence in US policy at the start of this month, Sharon. In the eyes of the Europeans, can you talk to us about changing perceptions of US assets? Have they been damaged over the past few weeks, and how repairable is that damage?
So Europeans have loved US assets in the last 10, 15 years. You've absolutely seen Europeans pivot towards the US, and you see this in many different guises. For example, companies, corporates invested more in the US. They moved more of their divisions to the US, etc. over time because the US has had much better growth. But also investors as well have loved the Mag 7. They've loved the opportunity to invest in tech stocks. They've loved the fact the dollar's been very, very strong. So Europeans absolutely love the US market. They've been one of the reasons that the US has done so well. You've seen a lot of flows into the US over time. That is being questioned a little bit, yes. I mean, not completely. I still think that the US over the next few years will outgrow Europe, but perhaps the gap will narrow a bit.
Can the flows make a U-turn if we get deals done within these 90 days?
I don't know if they will make a complete U-turn because there's a lot going on here. It's not just the tariffs. For example, it's the dominance of US tech globally. Is that now being questioned a little bit with competition, lower cost models coming from elsewhere, the extra capex and investment these companies are having to put in? They're no longer capital-light businesses, for example. It's other issues in Europe itself. For example, fiscal spend by Germany boosting growth in Europe. So I think that there's a combination of things here, and tariffs are just one part of that.
When it comes to looking at the entire policy perspective from the United States, I talked to the Treasury Secretary about this, and he said his advice to the investment community would be you have to look at everything together, the entire stool, which is tariffs, deregulation, and tax cuts. Do you get more bullish on the U.S. as we go down the calendar?
Because you're starting to see some of those other things come through, maybe tax cuts, etc. I think most of the tax cuts that we expect to happen will just be extension of the ones that are already in place. And I think most expect that to happen. So, yes, there may be a little bit of relief on that side, but the more that's done on that side, because the tariffs, whatever ultimately comes through, are probably inflationary, whatever relief you give the economy on the fiscal side will probably mean less relief on the monetary policy side. So, no, I don't necessarily think that that means a huge boost to growth.
Sharon, can we just sit on monetary policy? What are you expecting from monetary policy on either side of the Atlantic? We heard from Chairman Powell yesterday. We'll hear from President Lagarde later on this morning.
Yeah, well, we do expect the Fed to cut rates 3 times this year. We're not looking at a recession scenario. If we were, it would be deeper rate cuts. But we think that the Fed has got room to cut rates modestly from here. Although it's a balancing act, as Powell has pointed to, because the tariff and the tariff uncertainty is really causing a little bit of inflation risk to seep through into the US economy, even if there is lower economic growth. But the ECB, I think the equation's much easier, as we've been discussing earlier. I think the ECB will cut this week. Today, you've also got, in our view, more rate cuts to come from the ECB down to about a rate level of 1.5% this year. And the reason for that is economic growth in Europe is not that strong, but you've not got the inflationary impulse from the tariffs that potentially you've got in the US.
If anything, Sharon, they might face a disinflationary bust. Now, I'm not sure that's anyone's base case right now, but let's say the wars stay up in the United States and the tariffs stay on. China's got a lot of overcapacity and Europe might have to eat it. What does that mean for some of the earnings across the continent and the prospect of disinflation in the months and years to come?
Yeah, I mean, not all things about disinflation are good news for Europe. Europe has suffered under too much inflation in recent years, and that's been a hit to the consumer. So obviously, if there's more imports of low-priced China goods into Europe, it's great for the consumer. Also, energy prices have come down. That's good for the consumer. So there are plenty of good things, but there are also some risks for, say, European manufacturing if you see more imports from China. So I agree it's a balance. I actually think European earnings this year for stock 600 companies, for example, won't be that strong. The reason for that is weaker global economic growth, but also tariff risk, falling energy prices hitting the energy stocks, and the stronger euro hitting all the dollar earners in the index as well.
But when it comes to consumers, hasn't the euro appreciating actually helped them? Because right now the Commission hasn't retaliated against the U.S. tariffs.
I know, look, the European consumer has been very beleaguered in recent years, particularly around COVID, around the energy crisis, incredibly high inflation, negative real income, generally weaker European currencies and a stronger dollar. All of it's been bad news for European consumers. But actually now I think we're starting to see the reverse of that. So definitely some winners in Europe from this. Lower cost goods potentially coming in, but also lower energy prices as well, and a bit of a stronger currency giving them more purchasing power. I couldn't agree more with that. But it's a bit of a balance here. Consumers do a little bit better, but then other parts of industry may suffer. Having said all that, not super negative on European manufacturing. Obviously, you've got the fiscal spend and the defence spend coming through in Europe as well, which will give a boost to that.
Sharon, let's just finish on earnings season. On this side of the Atlantic, the financials projected confidence. We saw that from JP Morgan and for the institution you're a member of as well. What are we hearing on your side of the Atlantic? Because what we've seen from the luxury players, LVMH, Hermes, maybe a struggling Chinese consumer. What do you hear on your side of things?
Yeah, I don't think this is going to be a brilliant season for European companies. I think financials actually will do okay. Rates are still generally relatively high in Europe. Even if rates start to come down at the shorter end, long end rates still being relatively high, so steeper yield curve, not such a bad thing for some of the banks out there, financials. They're also often quite hedged for rates coming down too. So I'm not too worried about that group of companies, but there are others that perhaps will see a weaker first quarter. Those exposed to China, you mentioned, energy, for example, given energy prices have fallen through the quarter. So there are aspects, for example, of European earnings which are probably not going to see a stunning first quarter. Another sort of element of exposure is the dollar having fallen over that period of time. That's bad news for dollar earners, and they're a big portion of those in the European index.
Sharon, appreciate your time. As always, good to catch up. Send our best to the team. Sharon Bell there of Goldman Sachs on the latest over in Europe and their views on what's happening right here in the United States. Euro dollar at the moment, euro dollar 113.68. We heard it from LVMH, Pernod Ricard, seen it from Hermes as well. Bit of a struggle over in China.
Absolutely. That Chinese consumer is not holding up when it comes to luxury space. You know what's interesting as well about Hermes? They're talking about the fact that they're raising their prices as of May 1 in the United States to deal with the tariffs, because there's still a 10% tariff. Even though there's a reprieve on the higher reciprocal level, there's still a 10% tariff for those European goods coming into the U.S.
Some companies can get away with it, and I would say that's a company that can get away with it. We'll talk about them a little bit later. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. President Donald Trump sharing on Truth Social that trade talks with Japanese officials have led to big progress. A deal has not been reached, but preparations are underway for a second round of talks later on this month. Elsewhere, Ford is preparing to raise prices on cars if President Donald Trump doesn't deliver on tariff relief. The price increase would affect vehicles built in May, but wouldn't change pricing for those already in inventory. And finally, Nvidia in the crosshairs of US-China trade tensions. The CEO, Jensen Huang, is in Beijing after the Trump administration curbed the sale of its H20 chips to the country. Huang reportedly meeting with clients, including DeepSeek's founder. This is going to be very interesting today at a time when the Chinese leader is going around meeting with Asian allies, trade partners, talking about one big Asian family.
And it looks like Jensen Huang is trying to get ahead of what is going on in the U.S., the fact that they're looking to curb more of their exports to China, and also they're looking into potentially if any of those chips, Jonathan, were used when it comes to DeepSeek.
More on Nvidia later on this morning. Equity futures so far in the S&P nicely elevated going into the long weekend. Up next, the art of the trade deal.
The tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. All of this is highly uncertain. That's why we're waiting really to see what the policies ultimately are.
Up next on the program, Tobin Marcus of Wolf Research, live from New York City this morning. Good morning. Equity futures on the S&P positive here by 0.6% as the president says we get closer and closer to potentially a deal with Japan. Talks making, quote, great progress. Equity futures elsewhere on the Nasdaq up by about 1 full percentage point. In the bond market, yields declining for 3 consecutive sessions, so a bit of stability returning to the bond market. This morning, though, we snapped that streak. Yields high by 3 basis points at the front end of the curve on a 10-year up by 2. And the euro in focus with an ECB rate decision just around the corner. Euro dollar negative by a third of 1% to 113.65. Good morning, Mr. President. Putting this out on social media this morning. The ECB expected to cut interest rates again, and yet too late. Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another atypical complete mess.
So basically, he's once again jawboning Jay Powell, this time comparing him to Christine Lagarde. How come she's cutting rates and you're not? Too late, should have lowered interest rates like the ECB long ago, he goes on to say, but he should certainly lower them now. Powell's termination cannot come fast enough. I spoke about this with the Treasury Secretary. He says nothing to worry about right now, but in the fall, Jonathan, they're going to be interviewing candidates to take over when Powell is over in May 2026.
Do you think it's fair enough that Chairman Powell won't get an interview? Do you think that's fair to say?
I think that's fair to say at this point, especially when the president is literally saying in black and white to the world, his termination cannot come fast enough.
Termination's a very interesting word. Does that mean we allow the term to expire, or do we explore something else? I think people will be thinking about that this morning. What does that word actually mean?
I think people will be thinking about that. And I will say, before I sat down with the Treasury Secretary, because we were promoting it, I actually got asked. People were asking me, because of that Supreme Court decision that said the president at this moment was entitled to oust those top officials at 2 independent agencies, there was concern in the market about whether or not he would try to oust Jay Powell. We have to remember the independence of the Fed is a cherished pillar of why you invest in the United States.
It will be interesting to see how the market interprets those comments and what kind of clarification we get from the administration later on this morning. Equity futures still just about positive by 0.5%. Under surveillance this morning, the art of the trade deal.
The tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. Our role is to make sure that this will be a one-time increase in prices and not something that turns into an ongoing inflation process. All of this is highly uncertain. We're thinking now, really before the tariffs have their effects, as how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are.
It's the latest this morning. Chairman Powell isn't blinking, keeping the focus on President Trump, stating, quote, big progress was made in the latest round of trade talks with Japan. Bloomberg's Tyler Kendall joins us now for more. Tyler, encouraging on the trade front between the United States and Japan. But that headline that just crossed the Bloomberg terminal, those comments from the president on Truth Social, referring to the chairman of the Federal Reserve, Jay Powell. Your thoughts on that this morning, please.
Yeah, hey, John. Well, President Trump saying that Powell's termination can't come soon enough. Of course, we know that he's expected to leave his post in May of 2026. And as Anne-Marie said, she asked Scott Bessent earlier this week, who said no need to worry right now, but that they are going to start to look at other candidates starting in this fall. President Trump has long suggested that he should have some sort of comments over input when it comes to FOMC decisions. And he's really linked this directly to his tariff policies, often saying that lower interest rates would go hand in hand with him upping tariffs on our trading allies. So while, of course, President Trump has continued this trend, this perhaps appears to be the staunchest rhetoric that we have heard from him when it comes to an actual termination. Of course, NEC Chair Kevin Hassett has repeatedly said that this White House will respect the Fed's independence, but it remains to be seen if the rhetoric's going to keep ramping up as President Trump tries to imply that Powell is behind the curve.
Well, Powell yesterday said the tariffs are even higher than their upside scenario the Fed was modeling. Tyler, we had the Japanese delegation in yesterday, and today we have Giorgia Meloni visiting Washington, D.C. What does she come with?
Right. Well, Anne-Marie, this is largely seen as a test as to whether or not Meloni can use her affinity with President Trump to try to advance trade talks, particularly when it comes to the European Union. Of course, we know Meloni was here for President Trump's inauguration, considered to have a relatively good relationship with this White House, as President Trump says that he will be directly involved in all of the negotiations going forward. It's our understanding that Meloni is coordinating closely with European Union officials, which their negotiations haven't necessarily gone as well. Bloomberg News reporting earlier this week that the EU trade chief left talks in Washington with very little clarity on exactly what this White House needs to get a deal done. Now, our reporting does indicate that Meloni is expected to propose that all tariffs should be eliminated on bilateral trade between the EU and the U.S., essentially creating a free trade zone. Really remains to be seen whether or not that's something that this White House would entertain. One proposal, though, that might actually get a little bit more traction, Meloni is also expected to suggest that there should be a EU and U.S. trade summit where allies can come and talk directly with senior administration officials, both on trade but also defense, because, Anne-Marie, we know that this administration in particular is pushing for our NATO allies to boost their defense spending, and that likely will make their way into the talks today.
Tyler, appreciate the update. Tyler Kendall in Washington, D.C. I think we've got a new top story. This from the president this morning. The ECB expected to cut interest rates once again, and yet too late. Jerome Powell of the Fed, who is always too late and wrong, yesterday issued a report which was another untypical complete mess. The president goes on to say too late should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot come fast enough. Joining us now to discuss, Tobin Marcus of Wolf Research. Tobin, I would love your response to how you're interpreting that post from the president this morning.
Yeah, termination is not really the word that you necessarily would want to read from the president of the United States about the Fed chair. I do think that as a matter of prudence, it's still not likely that Trump is going to make a move to actually fire Powell. You know, as a legal matter, I do think that there's no real distinction between the Fed and the agencies where he has tried to establish a new right to dismiss independent agency heads like the FTC. So there's going to be litigation about that. To the extent that the administration succeeds in that litigation, that would establish his right to dismiss Powell. But I think that they're just not going to do it based on the market reaction. I mean, similarly, in their executive order asserting regulatory control over independent agencies, they made a point of saying the FOMC is not covered by this when it comes to monetary policy. And I think we're going to see the same approach in terms of personnel.
Tobin, are your clients concerned about Fed independence?
I think there are enough other things going on in markets that are concerning institutional investors that this is, at worst, kind of a vague worry in the back of people's minds. There's so much noise out of this administration, as we've seen in the tariff roller coaster since Liberation Day, that I think for the most part, this is going to need to be seen to be believed in terms of markets, like really trading this like it's materially impactful for their portfolios.
Do you have a sense who some of the administration's top candidates are to replace Jay Powell?
You know, I think there's a lot of overlap with the names that were in conversation for the Treasury Secretary job last fall. I think Bessent is certainly a possibility. We could see the old Dick Cheney move of sort of recommending yourself after interviewing various candidates. And then Kevin Warsh is a name that I think continues to be in the mix as well.
Toby, speaking of the Treasury Secretary, when he spoke to Anne-Marie earlier this week and she talked to him about the potential timeline for replacing Chairman Powell, he talked about interviews later on in the fall. There was a conversation on the campaign trail going into the election that maybe they'd select almost a shadow Fed chair, someone they'd select ahead of time who would go around making speeches and maybe the market would cue off what that individual was saying versus saying what Chairman Powell would say. Is your base case that they will not do that, or is that something you're still open-minded about?
So I'm not sure that they're going to formally designate a shadow Fed chair, and I recall that proposal came from Bessent, I believe. It was first anonymously sourced and then kind of reported from his own mouth. So obviously in a position to try and effectuate that plan from his current seat if they want to. So, I don't know that it's going to be that formal, but I wouldn't be terribly surprised to see them making a relatively early decision about who it is that they're going to put up for that job, trying to run the confirmation process essentially in advance, and, trying to turn attention to that person a little bit rather than the actual outgoing Fed chair in Powell.
Tobin, appreciate your update and your reaction to this one as well. Thank you, sir. Tobin Marcus there of Wolf Research. If you are just joining us, these are the headlines that come from the president this morning. He's complaining about the Federal Reserve not doing enough to reduce interest rates. Looking at the ECB, who's about to cut interest rates again, and I imagine it's annoying the president this morning, and going on to say too late, which is a new nickname, I suppose, for Chairman Powell, should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot come fast enough. Now, how this market interprets this story is important, and at the moment it's not interpreting it in a too negative fashion. Equity futures still positive by 0.6%, but that's a very loaded, powerful word to use on a morning like this morning.
The start of his truth, we've heard this before. He's annoyed with Jay Powell for not moving and cutting interest rates. It's that last sentence, this termination. Is he talking about May 2026 when Powell's term is up, or is he talking about doing something sooner, which would definitely unnerve investors because that would blunt the independence of the Fed?
As we look for clarity on that, equity futures right now still positive across the board, on the Nasdaq higher by about 1 percentage point. Up next, Angelo Zeno of CFRA on the latest tech sell-off from New York. This is Bloomberg. Interesting start to this morning. Equity futures still positive by 0.6% on the S&P. On the Nasdaq 100 up by 1%. The president saying they've made great progress with the Japanese in talks so far this week on the trade front. The president said just moments ago and on Truth Social, complaining about the chairman not reducing interest rates over at the Federal Reserve, unlike the ECB, which is expected to cut interest rates later on this morning. Should certainly lower them now. Powell's termination cannot come fast enough.
So I think market participants will say, we've heard the president talk about the fact that he's allowed to have an opinion. He thinks he understands where the economy is better than anyone else, especially monetary policy. So maybe they understand why he's voicing his concern about being too late. What is going to unnerve investors is the fact that last sentence, he says his termination cannot come soon enough. Is the president willing to wait till May of 2026, or is he going to do something else that is going to make a lot of people very concerned because they want to see an independent Fed in the USA?
Mike McKee's in the building. We'll catch up with Mike a little bit later this morning to get his thoughts on all of this. I want to get to some movers just briefly. Nvidia down almost 7% in yesterday's session, bouncing back just a touch this morning, up by 0.6, down 22% on the year so far, as the US slaps more curbs on chip sales to China. Interesting to note that Jensen Huang, the CEO, landing in Beijing today, so look out for headlines from that. I want to turn to Hermes and get you an update on luxury. Hermes this morning, negative by 2.5%. A rare sales disappointment from the luxury goods maker. Chinese shoppers reining in spending. Saw something similar from LVMH earlier this week. Plus, price rises coming in the United States at the start of May.
So you saw a lot of these luxury players actually double down in the U.S., say the U.S. is where we can make sure we have these luxury consumers, especially if China's looking a little bit weak. Now they have to deal with the fact that, are these luxury consumers still going to buy when prices go up? And Hermes is saying prices are going up May 1st because of tariffs. The issue is they're in a league of their own. And I think if you can already afford a $20,000, $25,000 handbag, you could probably afford it if it's going to go up 10%.
Can you say the same thing about a Ford? We'll get to price hikes there in just a moment. On our radar this morning, President Donald Trump saying, quote, big progress has been made in trade talks with Japan. Japan's lead negotiator meeting with Trump for 50 minutes and U.S. negotiators for 75, with another round of talks expected later this month.
This is really important because Besson has said to me that the first mover advantage potentially is the one that's going to get the deal at the start of the day. So you have to imagine those 70-plus partners are looking at how the Japanese are dealing with this administration. And if they are going to get a deal first, what are the contours of that deal? The concessions, the extraction, does it have to do with non-trade barriers, or is it really just about tariffs? That is going to be key for everyone else. They're really writing the pathway for success, potentially. We have to see what the deal comes in the end.
Auto's a big feature of this conversation. I mentioned Ford, so let's get to it. Preparing to raise car prices if President Trump doesn't deliver on tariff relief. The company planning to make adjustments for cars rolling off assembly lines starting next month, with the vehicles set to arrive in U.S. showrooms in late June or early July.
This is what they said in the memo. We anticipate the need to make vehicle pricing adjustments in the future, which is expected to happen with May production. Why is this? Because right now, they still have the tariffs in place, some of these tariffs, even though, Jonathan, there is full court press lobbying from the automakers to the White House trying to get some more reprieve. At the end of the day, if they don't have clarity, what we've seen, whether it's Hermes, whether it's Ford, they are moving ahead and raising prices to make sure they're not impacted on their bottom line.
The stock is up by 0.6%. Elsewhere, Taiwan Semi keeping its growth outlook for 2025 despite tariff uncertainty. The company expecting AI revenue to double and reiterating a goal set in January for mid-20% growth this year. Staying on tech, Nvidia looking to recover from Wednesday's declines after the Trump administration restricted its chip sales to China. Angela Zeno of CFRA writing, we estimate that this development puts about 8 to 10% of the country's revenue tied to China servers at risk and could empower domestic China competitors, specifically Huawei. Angela joins us now for more. Angela, welcome to the programme. What was your reaction to that news yesterday? And what do you anticipate Jensen Huang's going to do in China later on this week?
Yeah, so thanks for having me, John. When I look about what happened yesterday, interestingly, I'd say about 2 or 3 weeks ago, we had an internal meeting, and my belief was probably at some point in May, we'd actually see a GPU ban into China. And I'd say that kind of really fell off the table really quick after, there were reports that Jensen had met with President Trump at a Mar-a-Lago dinner. And, essentially that was almost kind of put off the table, right? So you kind of sit here yesterday, we look at the 7% pullback in the shares. That's probably about right in terms of the risk exposure, in terms of from an earnings trajectory for NVIDIA here, as far as the H20 is concerned. When you start thinking about the lack of exposure now in China, that meeting that Jensen had in China. Again, I mean, what Jensen has done here over the last couple of years is he's fought really hard to stay into China. There's been a number of export restrictions out there. They've had to continue to temper the performance on those GPUs, and really kind of the H20 is a China-specific GPU. So really, I think the meeting there is for Jensen to kind of just continue to say, hey, listen, we're committed to China. We're going to have to try to do it maybe another way. But, it's an important market. It's the second largest market out there. You've got some major hyperscalers in the likes of Alibaba and Tencent out there. So Jensen wants to be out there in terms of the NVIDIA exposure.
Angela, the good news for NVIDIA is they don't have a demand problem. They've got a supply problem. Can you say the same about all the other chip makers?
You can't, in some respect, in the near term, I'd say, NVIDIA is best positioned, even when you kind of hear Taiwan Semi's call just a couple hours ago. They kind of alluded to the fact that they are still supply constrained on the AI side of things. So that does bode well for NVIDIA. But it isn't necessarily about NVIDIA's prospects here over the next 2 to 3 quarters. It's about the sustainability of demand as we go into 2026. And you do see some risk of that now, or increased risk, if you're not able to play in that China market, which again, potentially is about 8 to 10% of their current revenue, at least on the data center side of things.
Angela, do you think the company is thinking about developing a new chip that can go to China, given the fact that the H20 was manufactured and developed so that it was able to export to China, given the U.S. export controls?
Yeah, I mean, I think we have to see what those new export controls look like, and if there's any way that NVIDIA and AMD can circumvent some of these new restrictions or what have you. But when you start looking at this new administration here, there's a part of me that thinks that they don't want NVIDIA to have any exposure, at least kind of on the AI side of things, in China. Again, remains to be seen. We'll see. They'll try to some extent, but I don't know if they're going to be successful this time around the way they were successful under the Biden administration.
How are you thinking about the sectoral tariffs when it comes to semiconductors that the president promises that we're going to see?
Yeah, I mean, and that's a good question. You look at right now, there's a Section 232 investigation that's going on. We're expecting some sort of implementation at some point in the second half of the year. Our base case right now is the fact that you're going to see some sort of tariffs. That is going to be a permanent effect on the semiconductor industry and the broader hardware industry. But our view is the base case is somewhere along the lines of a 25% tariffs. Obviously, anything significantly above that is going to be a risk. And there is, hopeful some hope on our end that it's going to be less than that. But when you look at the semiconductor industry specifically, one area that does have pricing power is the chip industry. They've been able to kind of pass higher prices on over the last couple of years, obviously on the leading edge side of things specifically. So our view is any type of tariffs that are announced or put in place is going to get passed through to those hardware manufacturers, which ultimately, if you're a company like Apple, will push that down to the onto the consumer themselves.
Angela, just before you go, how are you navigating earnings season so far? TSMC came out projecting some confidence, keeping their guidance basically unchanged. ASML, some disappointing orders from them. Do you put more weight on one versus the other at the moment?
Yeah, I mean, I think Taiwan Semi is the bigger play as far as kind of gauging the demand prospects across the broader semiconductor industry. I think, as far as going through earnings season is concerned, I think most of these companies will be relatively in line on it as far as semiconductors are concerned. I think the guidance also is going to be roughly in line. Most companies are probably going to keep a lot of their guidance in place, but most investors out there probably won't believe what the outlook is going to be, because it's more along the lines of what the second half in 2026 is going to look like. As you kind of go into the second half of the year, if the consumer doesn't show up this holiday selling season, you're going to start seeing inventories build, and that's going to end up being an issue for the semiconductor industry. So I think all eyes right now is going to continue to be on the policy side of things, and really that's really going to dictate how these semiconductor stocks move here over the next couple of weeks and months.
A tough 24 hours for the chip makers, that's for sure. Angelo, appreciate your time, sir. Thank you. Angelo Zeno there of CFRA on NVIDIA and a whole lot more. If you are just tuning in, welcome to the programme. Some very strong words coming from the President aimed at Fed Chair Jay Powell. This line right here, Powell's termination cannot come fast enough. With more, here's Mike McKee. Good morning, Mike.
Good morning, John. This does appear to be the first time that the president has actually threatened to fire Jerome Powell. He's criticized him since he returned to office, but hasn't said anything about terminating him. Now, the question is, of course, can he? Powell has said he won't leave if the president asks him to, and that he would fight any kind of termination. This all gets back to a case that's being fought over the head of the National Labor Relations Board, Gwynne Wilcox, whom the president fired. The argument is that under, you've heard the term Humphrey's executor, that the president can't fire somebody except for cause, the head of an agency, independent agency, except for cause. The administration argues it can. So the question is now before the U.S. Appeals Court for Washington, which has let Wilcox go back to work while they figure this out. But it's anticipated to go to the Supreme Court. Now, the question is, would it get to the Supreme Court and would they make a decision in time to really matter with Powell, whose term is up in May of next year?
Mike, Powell talked a little bit about this yesterday. What was his response?
Well, he was asked about it again, and he said no, he has no intention of leaving. He's going to serve out his term. The interesting thing, Anne-Marie, is that he hasn't defined what his term is, because he has two. He has the chairman's term, which expires in May of next year, but he's also a member of the Fed Board of Governors until 2028. If he were to leave the chairman's job right now, there would be no openings on the board, and the president couldn't appoint anybody. So it's going to be a very interesting situation, shall we say. I don't want to say it's a court case yet, but very interesting situation as this plays out.
Potentially. Mike, thanks for the update. We'll come back to you later on this morning. Mike McKee there on the President's words this morning. Language is important. That would be my question to the Press Secretary today. Termination. What did the President mean by that? Did he mean the expiration of his term as Fed Chair in May of next year, or did he mean something else?
I think that's a great question, because he just said termination cannot come fast enough, meaning I'm waiting out these next 12 months, or I am prepared to take action because I'm annoyed that he has a new nickname for him. Too late, Jay Powell is taking too long to cut interest rates.
You probably want to know how the market is interpreting this morning. So far, OK, still just about positive on the S&P 500. The S&P is higher by 0.4%, but rolling over. If you check out the bond market on a 2-year, 10-year and 30-year maturity, yields just a little bit higher, up by 2 or 3 basis points on a 10-year at 4.30. I imagine if we were in a situation where the President of the United States fired the Fed chair, we'd have a very different market reaction to the one we've got right now.
Absolutely. I think the market's looking at this and they're saying this is the rhetoric we have heard from Trump in his first administration, and we've heard it from him again as he's president in his second administration. He jawbones. He likes to have an opinion about the Fed, where interest rates are going, and about the individual himself, Fed Chair Jay Powell. If he was to do something, I really think he will have a market reaction, because before I sat down with the Treasury Secretary, this was something individuals were messaging me about. Please ask Scott Bessent what he makes of the Supreme Court ruling that at the moment the president can oust of top officials at independent agencies.
Certainly given up the gains this morning. Still positive, but only higher by 0.4% on the S&P. Let's get you an update on our top stories this morning. If you are just joining us, our top story. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social, he's too late and too wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Elsewhere, United Health shares are down after reporting first quarter earnings below expectations. The health insurance giant cut its earnings outlook for the year. The company now missing targets for medical costs several quarters in a row. Their stock is down by 19%. And your final story, Meta CEO Mark Zuckerberg wrapping up 3 days of testimony in the FTC's antitrust trial. Zuckerberg responding to evidence suggesting Meta bought Instagram and WhatsApp to eliminate competitive threats, arguing the acquisitions did not harm competition. Their stock is just about positive in the pre-market. Up next on the program, the president sticking to his words.
People are looking for some amount of clarity. I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here.
In just a moment, we'll catch up with the former senior Trump trade advisor, Kellyanne Shaw. She joins us next, and we'll give you an update on the president's comments this morning on Fed Chair Jay Powell. Equity futures still just about positive here, up by 0.4%. On the Nasdaq 100, up by 0.7%. Just got a message about the Dow. Why don't you quote the Dow? Because United Health is 9% of the index and hardly anybody owns the Dow. And if someone's screaming at you this morning talking about the Dow being down, seriously, choose a new TV network. The Nasdaq right now positive by 0.75%. That is why we don't talk about the Dow on this particular program. All right, rant over. Let's get to another rant from the President of the United States. This is what he's got to say. Powell's termination cannot come fast enough. What a line by the President of the United States.
I'm thinking he's the one that actually messaged you, because we do know that he is one of those individuals that actually likes quoting the Dow, and in his first term used to use it all the time, depending on how good his presidency was going. This line, Jonathan, is very hot, because it is not just saying, I can't wait for Jay Powell to not have that job anymore. His termination cannot come fast enough. Is the president talking about the end of his term as Fed chair in 12 months, May 2026? Or is he talking about something a little bit more nefarious in terms of firing Fed Chair Jay Powell?
If you want to take the temperature of the bond market this morning, there's no freak out to this headline. I think that's important. How is the market interpreting that headline this morning? Yields are up by 2 basis points on a 10-year to 430. At least for now, no real drama.
I think so now the market participants, I think, are seeing this as just Trump rhetoric. Trump taking the truth, voicing his concerns. He probably saw what Powell said yesterday. Definitely different than, say, what Governor Waller was talking about in terms of where he's leaning on with the mandate, the concern he has about inflation and about tariffs. So the market right now is just viewing this as Trump's voicing his opinion. He's done this before. He'll do it again. But if this was to move into potentially a firing, I think you'd have a very different market reaction.
Mohammed Al-Arian, 11 minutes away. He's going to have his reaction to that story in just a moment on this program. Under surveillance this morning, the president sticking to his word.
People are looking for some amount of clarity. I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here.
Here's the latest this morning. President Trump signaling big progress in trade talks with Japan, fueling Wall Street hopes that agreements can be reached to avoid higher tariffs on trading partners. Kellyanne Shaw, the former senior Trump trade advisor, joins us now for more. Kellyanne, it's good to see you.
Good to see you as well.
What are the prospects of making a deal in this smaller time frame with this many countries?
Well, I think the chances of making a deal with Japan seem pretty high, right? Like you've heard Bessent talk about the fact that there are about 15 countries with whom they're close to making a deal. I don't foresee 90 countries in 90 days, but certainly with some of our major trading partners with whom we have some of these significant issues, I do think the administration is very optimistic.
Let's talk about the one that's a little bit harder, China. They came out this week with a number of demands they'd like to see a response. By the way, we should note this was a Bloomberg scoop, according to someone familiar with the CCP thinking right now. Do you think this administration is ready to appoint a point person for Beijing to deal with?
Well, I think both sides are looking to see if there is an off-ramp, right? Like last week, we backed ourselves into a trade embargo between the two world's largest economies. So there has to be a way to resolve this at some sort of political level. And I think appointing someone seems like a reasonable way forward. But that said, the president has said that he wants to negotiate directly with Xi Jinping. So there's going to be some negotiations behind the scenes to see if they want to back off that approach or if they're willing to delegate one level down.
Do you think the likely scenario here is that there's a call and then they appoint someone, and then who do you think that individual is going to be?
Well, of the constellations of actors who it could be Secretary Bessent, could be Secretary Letnick, it could be someone like Jameson Greer. But I do think that in the last week or two, we've seen Bessent really take the lead publicly in terms of advancing some of the president's trade agenda points. So he would be a likely interlocutor with the Chinese.
When it comes to the other deals, and speaking of China, the secretary has insinuated he wants to shore up some of these other deals and then confront China together. Is that the kind of concessions they're looking for when they talk to Japan or the European Union or Vietnam?
Well, I think, like, taking a step back, this is existential from the perspective of the administration, that we are overly reliant on China, that the Western world has become overly reliant on China. And so it makes sense from their perspective to look at building alliances with other countries where they adopt some of the same measures that the United States does. And even from the perspective of third markets, if the United States and China are in this posture of not trading with one another, those goods are going to go somewhere else. They're going to flood other markets. And so I think that's what they're trying to get to. But the question for me is some of these Asian nations in particular, are they going to pick sides? Are they going to be willing to put up some of these barriers on China or not?
So when it comes to other investigations the administration is launching, we learned this week there is an investigation, a Section 232 on pharmaceuticals, on semiconductors, that was launched April 1st. Why did we learn about it this week?
Yeah, I have to say, I spent 10 years in government and have never heard of a secret 232, but that's effectively what we saw happen. Well, there is no legal obligation to notify the public that an investigation has been launched. There is a legal obligation to give the public an opportunity to comment. But some of this may have just been, there's so much going on that they failed to alert the public. Could be that they were just investigating and sort of got out over their skis. But for whatever reason, it's neither here nor there. We're in an active investigation, and the administration has 270 days to complete those investigations.
They have 270. How quickly can they wrap it up?
As soon as almost humanly possible. So that comment period is, I think it's going to be May 7th when all those comments are due. They could potentially announce the results as soon as May 8th. Now, I don't think it will be that soon. I think they'll give themselves another month to digest some of the comments. But we've heard Secretary Letnick say that within a month or two, we're likely to see some of those measures.
A couple of names in the mix right now. Who do you think's running the show at the moment?
I think Donald Trump. I think President Trump is running the show. He has always been his own trade advisor. But of the economic advisors who seem to be in the mix, Secretary Bessent, Secretary Letnick, Jameson Greer.
Does it surprise you that the Treasury Secretary has almost made a U-turn when it comes to these negotiations in the past 2 weeks? When I spoke to him after what Trump called Liberation Day, he said he wasn't part of the negotiations. He then clarified to me this week he meant he wasn't in charge or a part of the negotiations regarding the tariff rates on that big chart. How big of a disagreement was those reciprocal tariffs?
Yeah, in Trump 1, it was very clear that we had different advisors on different spectrums. So we had the free traders, we had the protectionists. In Trump 2, the difference between them is much smaller, right? So I think you have advisors who might have different perspectives, but their view is largely rowing in the same direction. So I don't see the same break in the same way, but I do agree that Secretary Bessent is much more active now in terms of driving some of the agenda, at least in terms of the public voice of the administration.
And this is certainly something market participants wanted to see, including Jamie Dimon at JP Morgan, who basically said that in a Financial Times interview earlier this week.
He said he's an adult in the room and he likes that he's now taking a louder voice when it comes to these trade negotiations and thinks he should be the point person. Neil Dutta has talked about this, the ascent of Bessent. And he said Trump has cracked a lot of eggs and now it's up to the secretary to make an omelet. So Wall Street is definitely feeling more comfortable that the Treasury Secretary is the one who's a bit more careful with his words when it comes to these negotiations. He's in the driving seat.
Kellyanne, it's good to see you. Thanks for dropping by. Thank you. The former senior Trump trade advisor, Kellyanne Shaw there. The president breaking some more eggs this morning with this headline on the chairman of the Federal Reserve, Jay Powell. Powell's termination cannot come fast enough. Those comments dropping in the last hour.
Parsing through these words, it's confusing. Does he mean the termination of the end of his term, or actually, I will do what I can to try to terminate this individual from that job? His term is up May 2026. Scott Bessent said, nothing to worry about here. We will start interviewing candidates in the fall, and we have some names that we're thinking about constantly in these conversations he has with the president. So at the moment, I'm going to go with what Bessent said.
More reaction to those headlines in just a moment. Equity futures on the S&P positive by 0.4%. Up next, Mohammed Al-Erin of Queen's College, Cambridge, Michael Zezas of Morgan Stanley will catch up with Alicia Rees of Wedbush and Jean Bavin of BlackRock. From New York, this is Bloomberg.
I'm concerned that you might have a freezing in the real economy here. The risk is real, and I think it's happening right now.
It really doesn't seem like there's any sort of catalyst that is going to change that narrative very easily soon.
The baseline is that we don't get a deep, lasting recession in the U.S.
The actual brunt of all of this, is likely going to be seen in the data in the early summer, even midsummer.
You got an economy that's probably in recession today, but I think as you get into the back half of the year, things can really evolve.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures still elevated by 0.5% on the S&P 500. On the Nasdaq 100 up by 0.7% as the president stresses great progress has been made in talks with the Japanese over trade. Coming up later on this morning, you'll get jobless claims, another read on the labour market at 8:30 Eastern Time, and an ECB rate decision at 8:15, followed by a news conference at 8:45. The president of the United States with some thoughts on the ECB and the Federal Reserve this morning. Why is the ECB cutting interest rates and the Federal Reserve isn't? That's a question he's got, and he stresses the following. The Powell's termination cannot come fast enough. That line from the president on social media in just the last hour.
It's the most important line. It's the line that's getting the most questions. Is Trump talking about Powell's end of term in May 2026, or is he talking about doing something else, trying to remove Jay Powell from his post, which Powell said would be illegal and he has no plans on leaving? It is not clear what the president meant when it comes to that term termination. And so far, Jonathan, we have not gotten a response from the White House.
Well, the chairman quoted Ferris Bueller just yesterday in an address at the Economic Club of Chicago, saying life moves pretty fast. For the time being, we're still well positioned to wait for greater clarity before considering any adjustments to our policy stance. The Fed chair's not blinking here. Hasn't really blinked at all in the past few weeks, and I think he doubled down on that in yesterday's speech.
And I also think he doubled down on the fact that these tariffs, he was talking about they're even higher than what their base case was, or their highest case scenario. I thought it was interesting, Jonathan, that he quoted Ferris Bueller, because there is a famous scene in Ferris Bueller when the teacher is asking about tariffs and the economic calamity it caused. It's that Bueller moment. And I think he quoted Ferris Bueller, a different part of the movie, but my head went straight to that scene.
You can ask him if that was deliberate or not the next time you see the Fed chair. Big hour coming up. In just a moment, we'll catch up with Mohammed Al-Erin of Queen's College, Cambridge on America's uncomfortable tariff journey. Mike Zezas of Morgan Stanley as President Trump signals progress on Japan trade talks. And Jean Bavin of BlackRock as Fed Chair Jay Powell stays on the sidelines. We begin this hour with stocks higher as the president signals positive US-Japan trade talks. Mohammed Al-Erin of Queen's College, Cambridge writing, the US has taken its economy and those of other countries on an uncomfortable journey to an uncertain destination. This will severely test the financial system and America's global standing. Mohammed joins us now for more. Mohammed, looking forward to spending the next 2 hours with you. Good morning.
Good morning. Thank you, John.
Want your reaction to this headline here from the president in the last hour. So out on Truth Social media platform, the president's following maybe some of the ECB commentary this morning, expectations that they'll reduce interest rates and complaining. Why isn't the Federal Reserve doing the same thing? And he ends this post with this line here, Mohammed. Powell's termination cannot come fast enough. Now, the debate we've had around the table is how do you interpret that line? Is that someone waiting for the expiration of a term that takes place in May of next year, or someone who's thinking about doing things sooner?
So only President Trump knows what that means, but it should come as no surprise. We know that President Trump has been frustrated at the absence of interest rate cuts. I suspect he got very angry when he heard Chair Powell yesterday. Chair Powell really put all the blame on tariffs, gave no possibility to the better outcome. Zero. Give it zero possibility. And then there's one thing you have to remember. I know that the conventional wisdom is that this is an attack on the independence of the Fed. There is another way of looking at this, which is this Fed has sacrificed people in the past. If you remember, the president of the Dallas Fed, the president of the Boston Fed, the vice chair were sacrificed ahead of Congress looking into allegations of insider trading. If you remember, the potential side was sacrificed to protect the monetary policy side. And it wouldn't surprise me if President Trump is pushing on this, because there's a real question for Chair Powell. Should he step down to preserve the independence of the Fed? Because otherwise, the Fed will be the subject of a lot of attacks going forward.
If he did step down, would that call into question even more the independence of the Federal Reserve? What's the optimal outcome here?
So this is a judgment that has to be made and has to be made by Chair Powell. There are credible candidates. Kevin Walsh, for example. The markets would be very comfortable with Kevin Walsh as the Fed chair. He has tremendous experience. He understands the markets. He understands economics. He has expertise. So, I could see a scenario in which what Secretary Bassett said before the election plays out, where they pre-announce Kevin as the next chair. And then that puts tremendous pressure. And then Chair Powell has to make a very difficult decision.
Let's say that happens. And I know that's not your base case right now. You can tell us if it is, but it hasn't been before. Let's say it happens, though. How do you think the market would respond to that?
So I think the market would look at Kevin Walsh and think he's a very credible Fed chair. And I think the market would rather have a credible Fed chair that's not in continuous conflict with the White House than being in continuous conflict with the White House. The Harvard example is an illustration of what can happen. You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
Isn't this conversation alone putting in question the independence of the Fed? You're talking about scenarios where we could basically get around the White House to placate the president.
But we've seen that. Scenarios where they've gone around the Congress to placate the Congress. We've seen a situation where in the beginning they sacrificed the potential side. Michael Barr was the vice chair, and he stepped down. So I don't think this is a much a structural break, but I do think there's a very delicate judgment, Anne-Marie, here, very delicate, and I'm glad I don't have to make it.
Well, it almost sounds like you agree with the president in this sense. His termination cannot come fast enough, meaning when Powell's out of the job, it cannot be soon enough. It sounds like you agree with that.
So the word termination is a very strong word, right? That word, I must say, I looked at it and I thought, wow, that's a really strong word. But we do know that in a year's time, Chair Powell will step down. We know that. We know that he's not going for a third term. We know he's not going to get a third term. So, that issue is out there. We also know the president is really frustrated about interest rates not being cut. And I go back. Yesterday's comments by Chair Powell, which he went well beyond what he's said in the past, were like a red rag to the White House.
You've been critical of the Federal Reserve before. You've referenced this address a couple of times now. What stood out for you yesterday? Where do you think the chairman went wrong?
So actually, I think the chairman yesterday was less political than he normally is. I do think that we all have to give the possibility of the good scenario. The market certainly does. You heard me say the market is 50-50 as to which of the two outcomes in the destination is going to play out. Is this going to be a Jimmy Carter moment with prolonged stagflation? Or is this going to be a Margaret Thatcher, Ronald Reagan moment where you rewire not just the domestic economies, but you rewire the global economy?
Isn't the Fed chair basically acknowledging that by saying we've got to wait for more clarity before we can decide what we need to do?
Yes, but he went much further. I mean, I have all that. He certainly said we have to wait for greater clarity, but he kept on pushing on the challenges to dual mandate. He kept on pushing that inflation may be persistent. He hasn't said that in the past. 2 meetings ago, he reintroduced transitory. 2 meetings ago, he reintroduced transitory when talking about tariffs. And then last meeting, he walked it back. And now he's gone one step further and made a very strong statement.
So let's talk about the optimal outcome. What does it look like in the months to come?
I think I am in the same boat that everybody else is, saying this is a really highly uncertain time. You know, I think this is an uncertain journey to an uncertain destination. And the market has been swinging one way and the other. You said it this morning. Depending on the tariff news, it's either excitement or fear.
Yesterday, we did also hear Jay Powell talk out the Smoot-Hawley levies of the 1930s, 95 years ago. And he said there isn't a modern experience for how to think about this. Do you agree with him, or can you draw some modern experiences to deal with this time right now?
No, it's hard. I mean, by the way, that was a strong statement as well, something that he hasn't gone anywhere near before.
And that was the Ferris Bueller scene I was alluding to earlier.
Correct. And I remember that scene that he should have referred to in the movie. No, we haven't had this before. This is an attempt to rewire the global economy. And we haven't had this in an integrated, globalized economy.
Are you surprised by how different Powell sounds from Waller?
Yes, I do. I'm surprised how different Waller sounds from Waller a year ago.
Think he's running?
It's been quite a transformation, let's put it this way.
Do you know who did do a good job yesterday? Raghu Rajan.
Oh, he was great.
He was absolutely fantastic. And he asked this question, I'm pleased he asked it. He talked about the difference of a challenge to the cycle and a challenge to the system. And you and I have reflected on this too. The challenge to the system here, how are you thinking about that challenge at the moment?
So first of all, let me say Raghu was great because not only did he keep the flow going, but for those who are not very familiar with economics, he explained why he was asking the questions, and he did it really well. You know, we've put it slightly differently, is that normally advanced economies live in cyclical space and developing countries live in structural space. Now suddenly we have advanced economies living in structural space, so the boundaries to the cyclical fluctuations are no longer holding, or they are much wider than they were before. So you have a whole range of potential outcome. I love the United earnings call when they came out with 2 scenarios. It's a bimodal world. Amex today came out with a huge qualifier saying it's subject to the global macroeconomy. So companies are not only thinking internally about a range of outcomes, they're expressing it in their earnings calls.
Asset allocators need to do the same exercise. They need to work out what the future looks like. And Rajan talked about a change in US philosophy. So in the post-war system, as you know better than most, US assets are at the very heart of it. And the interpretation of this administration appears to be that their responsibilities are a net burden and not a net benefit. And they're trying to rebalance that. They look at the FX so-called distortions, that's what Stephen Myron called them, and they don't look at the benefits that come from this structural bid for US assets that deliver lower interest rates than maybe they'd otherwise get. What are the dangers of trying to rebalance that over the period of, say, 3.5 years?
So whether it is the US, whether it is the UK with the EU, this integration does 2 things to your balance sheet. It increases the gains and increases the potential losses. So you now operate at a higher level of both. And if you don't manage the potential losses, then people will focus on that and forget about the gains. We saw that in the UK with Brexit. So I think the more integrated economies come, the more you have to manage the downside risks. I say this because AI is really critical in this. We've got to manage the downside risk to exploit the enormous benefits that come from that.
Mohammed, you said when you look at developing economies, it's structural. And like the United States, we're cyclical. Is everyone just viewing this moment wrong? Should we be thinking about a developing economy when looking at what is going on right now in U.S. in terms of policy?
Well, some have tried to make that parallel when saying it's highly unusual to see the U.S. having higher interest rates and a weaker dollar. That happens in the developing world. That doesn't happen in advanced economies. I think that's a step too far. I think what we're seeing is a portfolio reallocation from an overweight to the U.S. to more balanced globally. That is what we're seeing. And I thought Rick Reeder yesterday on the show was great with that.
Mohammed, you're going to be sticking with us, and pleased to say we'll be talking about the Federal Reserve and the ECB, that ECB rate decision, about an hour from now. Equity futures on the S&P 500 still just about positive by 0.3%, but rolling over well off session highs. That's the story in the equity market. Let's get you an update on our top stories elsewhere. Here is your Bloomberg brief. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Elsewhere, the president sharing on Truth Social that trade talks with Japanese officials have led to, quote, big progress. A deal has not been reached, but preparations are underway for a second round of talks later this month. And finally, Eli Lilly shares soaring after its latest weight loss pill met its efficacy goals, showing promise it could become the first approved oral GLP-1 treatment. Lilly saying trial users lost an average of 16 pounds at the highest dose. That stock is up by 13.5%. That right there is your Bloomberg brief. Up next on the program, Trump versus Powell.
People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors. We're never going to be influenced by any political pressure.
The political pressure is climbing. Mike Zezas of Morgan Stanley joins us next for more. Live from New York City this morning. Good morning.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Krishna Gua, Evercore, just nailing it. This line right here. If you like the tariff debacle in markets, you'd love the loss of Fed independence trade. Equity futures right now in the S&P. We'll let that one breathe a little bit. Positive by 1/3%. On the Nasdaq, up by 0.5. Under surveillance this morning, Trump versus Powell.
Our independence is a matter of law. Fed independence has pretty broad support across both political parties. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress, where it really matters. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors. We're never going to be influenced by any political pressure.
So here's the latest this morning. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough. Bloomberg's Tyler Kendall joins us now for the latest. Tyler, what do you make of that one?
Yeah, hey, John. Well, while President Trump has long been critical of Jerome Powell, this does appear to be an escalation. Of course, big interpretation questions, though. Is President Trump pointing to the end of Powell's term as chair in 2026, or is he threatening to fire the Fed chair altogether just one day after Powell said that the central bank would have less flexibility to cushion the economy amid tariff fallout, and also that he thinks market volatility is understandable because there's just so much uncertainty here when it comes to the tariff plans. Now, President Trump has long suggested that his tariff policy would go hand in hand, as he says, with lower interest rates. And we should keep in mind that up to this point, senior administration officials have largely brushed aside President Trump's prior criticism of Jerome Powell, saying that it's just his opinion and that they do respect the Fed's independence. But we'll have to see if we hear any stronger stances from administration officials today, particularly after Treasury Secretary Scott Bessent told Anne-Marie earlier this week that he thinks monetary policy is a jewel box that needs to be preserved, as he said. So really some big questions going forward. And you had mentioned earlier in the program that Bessent actually was the one that had floated the idea of potentially a shadow Fed chair on the campaign trail. Powell was asked about that back in December, 1 month before Trump took office. And he said that he didn't really think that was an option on the table, and also that he doesn't think President Trump has the legal authority to fire him. John, President Trump previously has said that he would let Powell serve out his term. But of course, big questions here in Washington about the future of independent federal regulators, particularly after last last month, 2 FTC commissioners were fired, they say, without cause.
Tyler, appreciate the update. Tyler Kendall in the nation's capital. To extend the conversation, joining us now, Mike Zezas of Morgan Stanley. Mike, welcome to the programme, sir. Not the news I imagine you thought you'd wake up to. What do you make of that last line by the president? The termination can't come soon enough.
Yeah, I mean, I can't parse precisely what he might have been talking about there, but I mean, listen, I think the issue of concern here for investors is one of whether or not you feel like you own too many U.S. dollar-denominated assets, and there does appear to be kind of this rebalancing trade going on where kind of the world was overweight this, and for very natural reasons, and there's probably some risk mitigation going on here. And so to the extent you see statements like this, or maybe you're concerned with the case in front of the Supreme Court right now, challenging whether or not President Trump has the authority to fire independent agency heads, you know, all of it suggests that there might still be some rebalancing, kind of getting more to a neutral stance with regard to global U.S. dollar-dominated assets. It's the type of thing that we think can still create some near-term U.S. dollar weakness.
When it comes to this potential that this is more than just Trump waiting out Powell's term and actually he wants to do something about it, if that were to happen, what would that mean for the dollar, for treasuries as these safe haven assets?
Yeah, I mean, listen, Powell's statement yesterday about broad legal authority, broad legal protections, that seems to be the consensus, and I'm not a legal expert, but that seems to be the consensus, and it seems to be pretty stable. So any action against that would sort of raise questions. Whether or not it succeeded, I think you introduced that question into the market. Then if you already have a basis where investors are kind of overweight or over-indexed to U.S. dollar assets, then more of this risk mitigation trade that you're seeing probably continues.
So, Mike, let me just get more clarity from you on this. You said rebalancing to a neutral stance. How far along this journey are we, and what does the destination look like?
Yeah, I mean, I don't have a precise answer to that question because I think we're still collecting fund flow data and asset allocation data. I just know we're not all the way there, right? So, again, I think this is really about what you sort of assess the probability of institutional controls breaking down are. And I wouldn't say it's our central case that we're going to have a problem with institutional independence in the U.S., but statements like these, the existence of this case in front of the Supreme Court obviously raise the question further. And so even if you're only partway through that trade, there can be more U.S. dollar weakness without there having to be an expression from investors of a general loss of confidence.
Mike, this builds on the conversation we started having last week in a much more material way when we saw Treasury yields higher by 50 basis points and the dollar weaker. And we asked the question coming into this week, what's the alternative? Where can you find the depth, the liquidity, the predictable issuer with dependable, credible institutions around it? What is the alternative?
Yeah, I mean, listen, your near-term alternatives are the yen's the most obvious one. Euro would kind of be second there. They are insufficient alternatives to the point that you just made. But this is why I think for the moment we can avoid this kind of more existential question and look at this as more of a rebalancing trade and say there's still potentially strength to go in those two currencies relative to the dollar.
It seems that another alternative has been gold. Gold has defied every single correlation. Risk on, gold higher. Risk off, gold higher. Weak dollar, strong dollar, gold higher. And you get a bit of profit taking, but gold continues to go from record to record. How long can this process go on?
Yeah, I mean, I don't think we have a high conviction view there. But to your point, I mean, there is this sort of whether or not you want to view it as a kind of fundamental pressure, kind of a mix of fundamental and technical pressures, which is the way I would describe it. It is sort of a pressure that sort of leads to demand for a broad array of assets. And again, I think like the yen, the euro, those are places you might look. Is there still positive pressure going into gold? Very likely. But I wouldn't say that we have as high a conviction there.
Well, every day it seems like gold is, having this new record high. We had one just yesterday. Is that a place just to hide it out if you're unsure what to do in this moment, Mike?
I think for some investors it is. I'm sure we hear from some clients who are more sort of, true believers in this as store of value. But at this point in the debate, you don't necessarily need to pick whether or not this is just kind of a flight to safety or whether or not you have a more secular case for the breakdown of the U.S. dollar. So again, I think we're kind of in the zone of this trade right now where the uncertainty introduced by the fact that we're even having this conversation is plus the kind of let's call it the positioning that's been heavy for U.S. dollar-denominated assets, kind of allows you to not necessarily have to choose whether or not this is a technical trade or a fundamental trade. There's just more flow in the direction away from dollars.
Mike, appreciate your view. As always, Mike Zuzas there of Morgan Stanley. Gold coming up in that conversation. What a run it's had. So far, year-to-date, higher by 27%. And this rally, Mohammed, we've talked about this a few times, predates this trade tension. This has been building for quite a while.
It has, and it's gained a lot of momentum. And a lot of people have tried to fade it, only to see gold go higher and higher. I do think that central banks, foreign central banks, at the margin, are looking to diversify away from the dollar. And they're doing it slowly. And gold has been a recipient of this of flows.
Gold just pulling away from all-time highs. We're down about 0.5% this morning. Up next on the programme, we'll catch up with Alicia Reese of Wedbush, previewing Netflix earnings. Those results coming out after the closing bell. And we'll have more on these comments from the Federal Reserve, or rather at the Federal Reserve, from the President of the United States. Powell's termination cannot come fast enough. That conversation continues from New York. This is Bloomberg. Two hours away from the opening bell, equity futures positive here by 0.5%. On the Nasdaq, elevated as well, up by 0.7%. Encouraging words from the president on trade. Not so much on Chairman Powell. We'll get to that in just a moment. Some moves to look for. Taiwan Semi, TSMC, projecting confidence, keeping its growth outlook for 2025. Still looking for growth in the mid 20% for the year ahead. The CEO saying demand has remained resilient. The stock is up by about 3%. I want to talk about Ford, down about a third since the high of the last summer. It's positive this morning by 0.2%, threatening to raise prices. We anticipate the need to make vehicle pricing adjustments in the future, which is expected to happen with May production. Important move from them.
I think it's an important move, and I think it's a really important signal and significant because Ford builds 80% of the autos that they sell in the United States in U.S. factories. So Ford is saying, we have to come out and raise prices because it's so uncertain and we're going to be hit with some tariffs regardless, even though we're lobbying the White House. What does that mean for the others, like GM?
That's the latest on the autos. On our radar this morning, our top story, life moving pretty fast for Fed Chair Jay Powell.
As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance.
It's moving fast this morning. President Trump with these remarks, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates. Trump adding that Powell's termination cannot come fast enough.
Big question if he means the termination, the end of his term, May 26th, or the termination like he's going to do something about it. So I think we're waiting on some clarity. We have to, depending on what the president, I'm sure he's going to be asked about this today. Neil Dutta nailed it yesterday. He probably picked up on what Powell was talking about when it comes to tariffs, how he kept coming back to tariffs, how it's on the high end of the Fed analysis, and quote tweeted a Trump tweet from 2019 where Trump said, my only question is who is our bigger enemy, Jay Powell or Chairman Xi? And he wrote coming soon, ? Meaning, is Trump going to come into this fight and push back on Jay Powell? Well, he did this morning.
We mentioned this note from Krishna Gua over at Evercore, so let's go back to that note. If you like the tariff debacle in markets, you'd love the loss of Fed independence trade. Mohammed, can you just reflect on that a little bit? What would that look like if we did lose faith, confidence in Federal Reserve independence?
I want to say if, because I'm looking at the bond market right now, it hasn't moved. It has not moved. Yields were up 2 to 3 basis points. Yields are up 2 to 3 basis points. So the bond market has completely brushed aside this issue. But if, I say if, the people will go back to the 70s and will remember what happened then, and there would be much bigger inflation premium in markets across the board. But I want to say if, because with the exception of the word termination, which is a very strong word.
True.
Nothing is surprising in that post.
We've said it repeatedly this morning. It's difficult to know how to interpret that word. Is that word basically referring to the fact that his term expires in May next year, or does it mean he's willing to go much further, do something far more drastic?
And I think that ambiguity is purposeful. I think the president is trying to have this debate and maybe have individuals that are renowned, like Mohamed El-Erian, come on and say, actually, maybe for the best of Fed independence, maybe Jay Powell should even consider stepping down. He is starting a debate now by just the use of this one word, and I think he knows what he's doing.
Well, let's explore the if. Let's explore that a little bit further. How do you think the international community, international investors would view that move? How would they treat treasuries and dollar-denominated assets if that happened?
What is the if? The if is really important.
If they fired him.
Without announcing the replacement immediately, who is credible like a Kevin Walsh?
Oh, you think the replacement's just as important here?
Oh, absolutely. You cannot replace something with nothing. Britain learned this during Brexit. We're learning this during the tariff thing, is if you don't have something credible to replace what you are bringing down.
But to extend it, Mohammed, because this is important, once you've fired one, it would open the possibility that the next one could be fired too, which opens the idea that they're just going to do whatever the president would like them to do. I think that's the issue really at play here.
It is, but it's the counterfactual. What if the Fed ends up in a Harvard situation, whereby every day there's a new attack coming from a different angle? So this is why I say this is a really difficult judgment. You've got to sort of guess what the counterfactual is likely to be, and then decide if your objective, which all our objectives should be to preserve the independence and integrity of the Fed, what's the better outcome?
Yeah, but the precedent this sets could be catastrophic. To John's point, it could be a domino effect where every single person can maybe get fired.
True. Alternatively, they could find different ways of eroding permanently and structurally the independence of the Fed. So this is a really uncertain time.
But to the rest of the world, doesn't it just look like the Fed chair now just does the president's bidding, and then we look like Russia or any other economy where there's that relationship?
That is certainly the risk. And I'm just saying, I said during the break, I love this quote from Justin Fox, that uncertainty has never felt this uncertain. And that's the world we're living in, sort of uncertainty being even more uncertain than uncertainty normally is.
It's what the last couple of weeks has felt like, that's for sure. This story is going to dominate the conversation this morning, no doubt. I just wanted to fit this in as well, that the president's also saying his administration made, quote, big progress on talks with the Japanese so far this week. The lead negotiator saying preparations are underway for a second round of talks later this month.
So these talks with the Japanese are being closely watched. It's been insinuated by the administration they could be one of these first countries to get a deal. Scott Bessent told me the first mover advantage is going to be that individual. Well, it does feel like they have the first mover advantage. They're the only ones that have gotten a sit-down with the president himself. But no deal yet, Jonathan. They still have another negotiation to go through. My question is, they only have 90 days. We're talking about July 8th, just after July 4th and that holiday weekend. Can they get even a dozen of these deals done? Usually trade deals take years to hammer out.
Clock is ticking, and certain companies are stuck between a rock and a hard place. The Infineon CEO, Jensen Huang, visiting Beijing at the invitation of the China Council for the Promotion of International Trade. His visit coming as Trump administration slaps China export curbs on Nvidia's H20 chip in the last 24 hours. Mohammed, we've had this conversation in the past. Choosing between one and the other. You wrote a piece a number of years ago. I forget the precise phrase you used, but it was the so-called fence-sitters. Certain countries that wanted the trade relationship with China but wanted the security umbrella from the United States. How sustainable is that now?
It is much less sustainable and it's much more expensive. I called it the dual option model, that you have an option on the US for national security, you have an option on China for economic prosperity, and the cost of that option was extremely low. Now the cost of that option is going up, and most countries are terrified of having to make a choice between the two. Some countries will remain swing states. Brazil, India, Saudi Arabia, UAE, they have something special that allows them to be swing states, that allows them to maintain that dual option at a low price. But others, Philippines, Japan, etc., will find it much harder.
When it comes to things like chips, though, you see the Trump administration doubling down even further than the Biden administration did when it comes to these export control and chips. This H20 was produced and manufactured just so they could go to China. But you're going to find bipartisan support for things like this. de-risking from China, making sure they don't have access to high technology. But I have to think, with Jensen Huang going over to Beijing, this feels like Tim Cook and what he does and goes over to Beijing. And when China comes out and says, we want a point person for trade, I wonder if it's these diplomats, these corporate executives.
You've got to think about what she's doing. And yes, corporate America have been great diplomats for the objectives of the Chinese over the last few years, and that's a very separate story. And the administration, quite rightly, has been unhappy with them on that front repeatedly. The Chinese are also doing their own diplomacy. She's been visiting various countries, speaking to various nations, Malaysia, Vietnam in the last week. Mohammed, as you know, this president would like our trading partners, allies, the likes of the Europeans, to put the walls up for the Chinese. They'd like the Vietnamese to do the same. Do you think that's possible in the year to come?
It is possible. I mean, there's two big games of chicken going on right now. One we've already talked about, the administration versus the Fed, and the other one's US versus China. And US versus China visibly is a tariff. Behind the scenes is trying to get a coalition of countries against the other country. So you've seen this in China. They are doing a lot of diplomacy, quiet diplomacy, trying to say we are the reliable, we are the dependable superpower here. Let's have more trade links. Let's talk about payments links. And then you have the US saying, let's unite all these countries, starting with the 17 we're talking to now, not only to ensure low tariffs, but to ensure that they put tariffs on China as a way to protect themselves from Chinese dumping. So it's fascinating to me that you have a very visible war going on, tariffs, and then you have a less visible war going on, which is for the other countries.
The Europeans certainly stuck in the middle here because they'd have to eat the overcapacity coming out of China if the wars stay up here in the United States. More on the ECB later on. That decision is about 35 minutes away from the European Central Bank. We need to talk about earnings later as well. Netflix reporting earnings after the closing bell, with analysts expecting it to weather the macroeconomic climate better than competitors. Alicia Rees of Wedbush writing, while massive subscriber growth was the primary driver in 2024, we expect price increases to drive revenue growth in 25 and the ad tier to drive revenue higher in 2026. Alicia joins us now for more. Alicia, welcome to the programme. There is some pressure on consumers. Sentiment is absolutely cratered. Alicia, as we saw in retail sales, though, they are still spending. But some of that spending is about fears of higher prices in the future. What do you think this will mean for discretionary growth on things like Netflix?
Well, I think for now, the key driver is content. There certainly comes a time where people will cull their budgets and stay home. Skip a vacation, maybe buy a few less new items. And what they'll do instead is stay home and watch content on Netflix and other streaming services. And so whoever has the best content gets the most eyeballs, and whoever gets the most eyeballs can get the most advertising dollars. Netflix doesn't have a lot of people yet on their advertising tier, but they're certainly trying to grow that, and they will over time. But still, this year, they are not going to give subscriber numbers. And what they're going to do instead of giving subscriber numbers is, they increase their tier pricing. And so they're going to be able to give quite a bit of revenue growth still.
I understand.
On top of that, and it's going to be really positive for them.
Alicia, I understand people may stay home if they're worried about going out and spending in this time of uncertainty and tariffs and potentially prices going up. But advertisers, are they going to have the money in this uncertain environment to want to spend?
They're certainly going to cull their budgets and pull back pretty significantly. So they have to be more accurate. So they're going to want to move a lot of advertising dollars from linear TV that is less targeted to connected TV that is highly targeted, on par with or better than social media targeting. Connected TV has significantly more targeting capabilities, and that's really where the eyeballs are, especially in an environment where, people are staying home a bit more. And as sports continue to shift towards connected TV from linear channels. So advertisers are just going to be a little pickier about where they put their dollars, and they know people are on Netflix. So that should insulate Netflix to a degree.
So, Alicia, I hear you say that we're going to get an acceleration of a secular move. So how does linear TV respond?
So linear TV has to keep sports as much as possible. What Disney's doing is taking ESPN and just creating a lot of different outlets for it. And
I think we lost that connection there with Alicia Rees of Wedbush, looking ahead to an Netflix earnings after the closing bout. Exciting stuff, Anne-Marie.
Exciting
a bit
stuff,
later.
I guess, when it comes to sporting and whether or not you get that on Netflix. I've been thinking about this when it comes to Netflix earnings because the Wall Street Journal recently had a piece saying that they aim for $1 trillion market capitalization. How do you do that at a time when people are uncertain? Are they going to be spending more? If you don't already have a Netflix subscription, why are you going to sign up now when you see poll after survey that people might be holding back?
How many zombie accounts do they have? Just people who are signed up, still paying, but never watch the thing?
Oh, I don't know about that.
I asked that question because I'm one of them. I've got one of those zombie accounts.
Well, how many people are some of those password cheaters? Because I'm one of them.
I know you're one of those too. They're clamping down on that, as you know.
I'm stunned between the two of you.
I want to know what Netflix version of White Lotus is. What's their hot new... Are you watching anything?
Someone else can tell you that.
I am, but why don't you take his account, which he's not using, and you don't have to see... I mean...
You're right.
What, and I keep paying? Yeah. No, Mohammed, that doesn't make sense.
You're paying anyway.
No, and the first thing that will go when things really start to bite is the Netflix account, which is why I ask how many zombie accounts are out there.
There's probably a bunch, I imagine.
I think a lot of people just have accounts and don't watch anything. Anyway, let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. Goldman Sachs looking at the worst-case scenario for US and China decoupling. US investors may be forced to sell around $800 billion of Chinese equities, and Chinese investors might need to offload $1.7 trillion of US financial assets. Elsewhere, New York Congresswoman Elise Stefanik is weighing a run for governor in her home state. Stefanik's allies confirming her interest in the race, with the Republican lawmaker increasingly outspoken in recent weeks with criticism of Governor Kathy Hochul. And finally in sports, the Champions League semi-final matchups are set. Arsenal taking on PSG after besting Real Madrid to reach their farthest in the tournament since 2009. Elsewhere, Barcelona facing Inter Milan, the next round kicking off on April 29th. And that right there is your Bloomberg brief. Up next, a hawkish Chair Powell.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation.
That explanation up next. We'll catch up with Jean Bavard of BlackRock. Equity futures just about positive this morning. We're up by 0.4% on the S&P, on the Nasdaq higher by 0.7. Under surveillance this morning, a hawkish Chair Powell.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. Markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, conditional on being in such a challenging situation. Markets are doing what they're supposed to do.
So here's the latest this morning. Stocks are heading for a week of losses as Fed Chair Jay Powell pours freezing cold water over the so-called Fed put. Joining us now to discuss is Jean Bavard of BlackRock. Jean, good to see you, sir. Some reaction by the President of the United States earlier on this morning, which I'm sure you saw, complaining that the chairman had not cut interest rates, unlike the ECB, which is set to do in about 30 minutes' time, and saying at the end of his social media post this morning that Powell's termination cannot come fast enough. If clients asked you about that line this morning, what will you tell them?
Well, I spent a week in Europe last week, and I'm going to tell you that the discussion about like U.S. asset and how we should think about this environment is totally different than everything I've seen. And I think that kind of development in the context that is already one that investors are shaky, I think will require quite a bit of work to reassure. I think what I would say I would fall back to. I think there are immutable laws that are at play here. We're going to be bumping into them. We need to be ready for some chaos along the way, but we're going to be bumping into some pretty immutable laws, and I think that's what we need to get a handle on.
We've said repeatedly on this programme this morning that we'd like clarity from the White House what termination actually means. Does it mean the expiration of the term, May next year, set to take place, or moving that forward and doing something more dramatic? But you've touched on something important. The erosion of trust in US assets that we've seen. Some people have made the case that over the last week, all we saw was Treasury markets responding to the unwinding of trade, some hedge funds blowing up, and maybe it was nothing bigger than that. What do you think it was?
I think there's a broad story here, and if I had to say one word, I think it's debt. It's the large U.S. debt that is a big part of the story here. But I think what we've seen, we were of the view, we've discussed that before, that we were in an environment shaped by supply. I think the tariff discussion we're having here is very much an example of another supply shock that is leading Chairman Powell to be more hawkish than people expected, I guess. But there is a really real story of a supply shock that is putting pressure on rates to go up. So I think there was already pressure for long-term rates to go up. But you add on top of that, questions about tariffs that are really like, if you really are trying to decouple from the rest of the world quickly, that also means that you're cutting yourself out from a source of funding for your debt. And the debt is large. And I think this is the key thing that is driving here is that, the financiers of that debt, the people financing it, are looking at this differently now. And I think that's adding another kind of risk premium, if you will, in terms of long-term rates. And so that is the dynamic at play. It's not about one player. It's not about one official government selling or not. I think this is a broader kind of sentiment story.
So Jean, you told us about what you heard. You told us about the sentiment. How far are we in this rebalancing from the U.S. to the rest of the world?
I think we're pretty far. I mean, if the real intent of reducing current account deficit and surpluses and balancing these things, we're very far from that objective and decoupling. And in fact, I don't think that can happen very quickly. So to me, this is more that there's a very near-term kind of immutable kind of constraint that we're going to be bumping against, as I said before. And it's going to be materializing by rates going up, which will make the debt look very different for the government, I think, themselves. I think the biggest challenge for them is rates at 5% in 10-year changes completely the budget arithmetic going forward. And I think that will have to be confronted at some point. So that's why, I mean, no matter the intent, I think we're going to be stopped along the way. It's a many years process as opposed to a many months process.
And that goes against a key objective from this administration, which is to keep rates much lower. They want to see it going lower to 4%. When it comes to things like who is dumping these assets, the Treasury Secretary didn't seem to think it was foreign governments. Do you think it's sovereigns?
As I said, I think this is a broader global reassessment and thinking. I think there is broad fundamental reasons for rates to go up, and then you get events like we got last week, and it adds to this narrative. So I think it's difficult to pinpoint like a single source. I think this is broader. And then when these things happen, there's always other things that happen at the same time. So you get like the dynamic deleveraging in the market that gets triggered by this. So I don't think we'll ever pinpoint one, but I think we should take note that there is a sentiment story that is playing out.
So, John, one of the things that is really debated right now among global macroeconomists is what is the beta of the rest of the world to U.S. growth? So some people feel that it's 0.5, others feel it's more than 1. Where would you put the beta, the growth beta of the rest of the world relative to the U.S. for Europe and for developing countries?
I think there's a distinction between where this administration might want to go in many years from now and where we are right now. I don't think the world has changed materially yet. I mean, yes, the tone and everything has changed like drastically, and the uncertainty is as uncertain as we've ever seen it, as you said before. But right now, the fundamentals, where the U.S. is still very much as linked as it was. And I think we've seen it, right? When we've seen Liberation Day, we've seen the U.S. market tank. It's not like Europe has outperformed during those days or other markets. So the beta is still very much as strong as it was. Over time, it might change.
More than 1 or less than 1?
I think we're looking at something that looks like 1 right now. So I wouldn't take a big bet on either side, but I think it looks like it's very much correlated with.
Does that mean you can't take as big a bet for Europe against the United States and vice versa, if they're all in the same boat?
Yeah, so I think it's tempting to say U.S. is risky, so let's go elsewhere. But because of that beta, I think we're still in a world where all boats will be moving together. But there is one thing happening, though, is that in this environment, clients have always been having a home bias, right? It's easier to invest closer to home. I think that exacerbates that home bias that we have. So it's in this environment.
Your high conviction view is actually in the Treasury market. So shall we finish on that? Underweight Treasuries. Is it for all the reasons we've discussed or something missing? We had on top of that the inflation story that is not resolved. It's actually being, fueled somewhat more with those measures. So
We have been underweight U.S. Treasury. This is the highest conviction we've been having for the last many months, even I would say many years. We're resetting to a higher rate environment. Everything we see confirms that, and the latest development, I think, add to that as well.
And the latest communication from Chairman Powell would reinforce it too. Jean Van of BlackRock. This Federal Reserve not in a rush to do anything anytime soon.
Rates on hold, quote, for the time being. It seemed like Chair Powell was not in a rush to even give the market a little bit of a Powell put, saying we're going to step in. He was leaning on the fact that the inflation story, they just don't know yet. Looking at the survey data, they just don't know how these tariffs are going to complicate price pressures.
The President of the United States watching the ECB of all things this morning. The European Central Bank set to cut interest rates in about 20 minutes' time. Widely expected to anyway. The President unhappy that the Chairman of the Federal Reserve is not considering doing the same thing. Big hour coming up. An ECB news conference just around the corner. Decision 20 minutes away. And we get some data at 8:30 Eastern time when we have jobless claims in America. Up next on the programme, Alex Altman of Barclays, Bloomberg's Lizzie Burden, Pooja Kamra of TD and Lauren Goodwin of New York Life. And Mohammed sticking with us for another 60 minutes.
There is real damage happening today, right now.
There's a lot of bad sentiment, and that's helped the market recover.
People are looking for some amount of clarity.
Markets are very jumpy and very uncertain these days.
The appetite for U.S. assets could be something that is a question.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures positive on the week so far, heading towards a week of losses. On the S&P at the moment, higher by 0.5%, attempting to take a bite out of this weekly loss. The Nasdaq up by 0.8%. As the president says, talks are going well. We're making big progress with the Japanese. That's opening the door maybe to a trade deal before this 90-day pause expires. Coming up later on this morning, this hour, 8:30 Eastern time, jobless claims just around the corner. Before we get there, an ECB rate decision, then a news conference 30 minutes later at 8:45. The president watching the ECB rate decision, unhappy that the ECB is expected to cut interest rates and this Federal Reserve isn't set to cut anytime soon. Complaining about the Fed chair and saying this at the very end, Powell's termination can't come fast enough.
A rare applause from the president when it comes to Europe and the ECB. A dose of uncertainty he throws in about the independence of the Fed, using the term termination. We need some clarity from this White House. Is the president talking about May of 2026 when Powell's term is up, or is he talking about actually trying to oust the Fed chair?
Based on the market reaction this morning, I'd say that most people are saying it's the former and not the latter. Mohammed, futures up, bond yields not doing much. We've barely blinked in the face of that statement.
Right. As I said, I don't think anything is surprising other than the word termination in that statement.
I've been surprised by a lot over the last 2 weeks.
That's true. We don't know. I will say the Secretary, Scott Bessent, Treasury Secretary, said to me earlier in the week, this week, I believe that monetary policy is a jewel box that has got to be preserved. There is context that you brought up earlier, Jonathan, that's really important to this moment. It's the fact that we do have two top officials that were ousted from independent agencies, and the Supreme Court came out and said, at this moment, we're going to let the president do that. And that is why investors have been concerned about the independence of the Fed. Can the president do what he did say to the FTC?
The ECB decision about 13 minutes away. Coming up this hour, we'll catch up with Alex Altman of Barclays as stocks look to snap a two-day losing streak. We'll speak to Pooja Kamra of TD Securities, reacting to the ECB rate decision, and Lauren Goodwin of New York Life on why it's a vital time to reconsider asset allocation. We begin this hour with stocks higher on rising optimism over trade talks. Alex Altman of Barclays writing, investors are very much at the mercy of the policy path of President Trump. And with that heightened uncertainty, the opportunity set to run a large portfolio inevitably shrinks. Alex joins us now for more. Alex, good morning. Good to see you.
Good morning. Good to see you.
Better time since we last spoke.
Marginally.
Have things settled down from your standpoint?
In some ways they have, and in some ways they have not. Of course, we can think about the fact that the level of markets is lower than where we last spoke. But at the same time, volatility's also come off the ball a little bit. And so I think the key message, though, is what's happening in the bond market. Has that sort of began to stabilise from last week's jitters? And at the margin, I would say yes, but we're very much still on tenterhooks.
Stability this morning and certainly this week, jitters last week. What did you think the jitters were about?
It wasn't one specific thing. It was a multitude of things. So, of course, people were looking at pointing at foreign selling of it. And then there was a specific focus on, say, the fast money community and the levered community that had, like, whether it was bond basis trades or SLR relief trades on the swap spreads. But in truth, it wasn't one specific thing. We actually hosted a large call with our US rate strategy yesterday just to examine and do a deconstruction of this point. And what we found is that it was a combination of both technical and fundamental factors, and including let's not move away from the fact that this decline in US exceptionalism, which obviously we discussed last time as well.
So, Alex, you used the word marginally in responding to John's it's a better time. Drill in a bit marginally. What are you looking for?
Well, so what our big focus has been is uncertainty. Right, so uncertainty for us is really, especially within equities, is a compression of the multiple. And so what we think has happened within the US equity market, really year to date, is just priced in that uncertainty. But we haven't priced in really a recession. We haven't priced in a meaningful decline in earnings. So what we're looking for is either removal of that uncertainty, which will obviously drive, I think, equity markets back up. I don't think they're going to go back to all-time highs in the near term, and that's just because we're still dealing with an administration that could be perceived as quite volatile. But at the same time, we haven't seen that precipitous drop in the economic data as well, which would drive the S&P down to some of the more bearish targets that we're seeing.
So give us your probability distribution between a good removal of uncertainty and a bad removal of uncertainty.
Right now, I would say that we're leaning more towards the bad removal.
By how much?
In terms of the S&P levels.
Yeah.
So I think that if you start to look at, say, a 2022 analog where we didn't actually have a recession, but the market was quite vehement in pricing one in, we troughed at around about 15 to 16 times. If you put that on, say, an unadjusted earnings of, say, call it 255 or 260, which is still growing year on year, just might I add. That's down a lot from where we were, say, at the beginning of the year in the 270s for the S&P, then we're looking at probably still around about between 4,000 and 4,200 in the S&P.
When you say uncertainty, do you mean tariff policy?
I mean tariff policy, but we've also discussed other aspects of uncertainty, whether it's monetary policy as well. And indeed, I think we've also got to put on the table geopolitical uncertainty as well. We've got to think about what's happening with Iran. We also have to put on the table as well, potentially, if there is an escalation with China that moves beyond just tariffs into more economic warfare, or dare I say even kinetic. And I think that's something that's very hard to discount, but nonetheless, it's something which, again, if we're going to put within the realm of possibilities, you have to put everything on the table.
Hearing from the President again this morning, saying I had a very productive call with the President of Mexico just yesterday. Likewise, I met with the highest level Japanese trade representatives. It was a very productive meeting. Every nation, China, wants to meet. Today, Italy. Is there any evidence that China wants to meet?
Not at this moment. I think what China has put out, and this is also through a Bloomberg scoop, this is based on our reporting, is they put out a number of parameters they want the administration to meet before they're even willing to have these conversations. That means reining in some of the hot rhetoric we've heard from cabinet ministers, and also for the president to appoint a point person, put someone in charge of these negotiations.
I know this is frustrating, trying to read the tea leaves of all the communication coming from the White House, but it's interesting. When the president says China wants to meet, and there's no evidence of it, I think maybe spend less time questioning that and question why he's saying it when there's no evidence of it. Because I remember in the first term, and I always repeat this story, when markets were in a pretty volatile period and the president came out and said, just had a call with China, and there was no evidence of the call ever taking place. But the real point was that he said, I've just had a call with China, which gave you the impression he was worried about how investors were responding to the news. Do you think it's important that we're hearing more about negotiations and exemptions and less about punishment of allies?
I think it's very important because at the margin it's telling us two things, one of which I think you've answered, which is when as much as they say we're not looking at markets, they are looking at markets. And I think last week's bond wobbles was evidence of that. And then, sorry.
I was going to say the president's doing two things at once. He's talking down the market, potentially, talking about the termination of Fed Chair Jay Powell. He's talking up the market about all these calls, the negotiations, and how he's personally involved. Do you think we're at peak uncertainty? The Treasury Secretary told me he thinks the VIX has peaked. Do you think that's true?
I think that the VIX is not really a reflection of uncertainty. I think the VIX is a reflection of many things within the equity market and a function of skew and obviously volatility and whatnot. Do I think we're at peak uncertainty? We may be close to peak uncertainty, but I think you've got to delineate that from are we at peak, say, negativity? And that's not necessarily the same thing. And that's kind of back to my point in terms of I think the S&P or just US markets in general have done a lot to reflect the fact we're in a new regime of uncertainty, but it definitely has not done all the heavy lifting to reflect all that negativity.
So you're worried about the downside to U.S. equities. If I listened to you and I sold some of my U.S. equities, where would I go?
So this has been obviously the question all year is where do you go? I think there's a couple of things you have to keep in consideration. First of all is the opportunity set. So you have to go where there is genuine valuation opportunities, and that is not necessarily that obvious. We've had a kind of an everything rally for a long period of time. However, there are pockets, and this is something which we discussed last time. For example, some of the LATAM countries are actually behaving incredibly well. You've also got to think about the fact, I mentioned Mexico last time on this panel, and Mexico is a very interesting beneficiary, I think, of what's happening with regard to potential sort of protracted trade war with China. But on top of that, I think we've got to look back again at pockets of Europe as well. For example, Europe trades on 13 times, not particularly cheap, but at the same time, it is embarking upon a fiscal expansion process. And so if you compare that to the US on 21 times, which is going through, at the moment, fiscal neutrality or even fiscal contraction, then you have to sort of start weighing up the odds of, okay, where do I want to be? The other point, though, is liquidity. The biggest challenge for investors right now, this is back to the fact that the opportunity set, it shrinks just simply because the US still represents the best part of 2/3 of global market capitalization.
So the first part of your answer, I hear keep your equity beta where it is, just reallocate from the US to the rest of the world. The second bit of your answer is reduce your beta, your equity beta. Which is it?
I think you reduce equity beta. I don't think it's a prudent place to be in US equities when they're on this valuation with this level of uncertainty. And I think that we have to consider the reality that the longer that this tariff uncertainty goes on, the more damage it's going to do to the economy. If it's resolved quickly, then great. But I think that if we're in it for the long haul, then we have to accept the fact there will be implications to the economy.
Alex, appreciate your time. Great breakdown. Thank you, sir. Alex Ullman there of Barclays on the latest. An ECB rate decision just around the corner. That drops in about 5 minutes' time, 8:30 Eastern time. You'll get jobless claims. And then at 8:45, so in about 40 minutes from now, you'll hear from the President of the ECB, Christine Lagarde. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief. President Trump with strong remarks for Fed Chair Jay Powell this morning, posting on Truth Social that Powell is too late and wrong, calling on the Fed to cut interest rates, adding that Powell's termination cannot come fast enough. Elsewhere, Taiwan Semi reporting better than expected quarterly sales and maintaining its revenue growth outlook despite tariff risks. The chip maker stressing demand has remained resilient and expects AI revenue to double. And finally, the LVMH CEO, Bernard Arnault, saying the luxury group's demand trends are worsening as aspirational shoppers cut back more than higher-end consumers. Arnault adding tariff talks are also weighing on the outlook. That stock is down just a touch this morning by 0.1%. Up next on the programme, we'll catch up with Pooja Kumar of TD Bank with an ECB rate decision just around the corner, and we'll head over to Frankfurt, Germany to catch up with Bloomberg's Lizzie Burden from New York City. You're watching Bloomberg TV. ECB rate decision about 60 seconds away, so look out for that. In just a moment, we'll head over to Frankfurt, Germany and catch up with Bloomberg's Lizzie Burden. Equity futures going into it just about positive on the S&P by 0.5%. On the Nasdaq 100 up by 0.75%. The headline coming from the President of the United States is that Chairman Powell's termination can't come soon enough. Had a bunch of messages from terminal subscribers looking through this, seeing it as noise. And you see that reflected in the bond market. Mohammed, you were talking about this too. Bond market's hardly moved. Yields are higher by 3 basis points. If you really thought that the independence of the central bank, the Federal Reserve, was about to collapse, I imagine you'd be picturing different moves in the bond market this morning.
Oh, totally. You'd see yields higher. You'd have a different reaction, and you would see a lot more disorderly volatility. But you're not seeing that.
Certainly don't have that right now. Anne-Marie, we're going to be waiting for that clarity that comes from the White House. What did he mean by that? What is he talking about? Terminating him or just waiting for the expiration of his term?
We're either going to have to wait for Caroline Leavitt or at some point if the press sees the president today, which I'm sure they will as he greets Giorgia Meloni, they're going to want to know, did you mean the end of May 2026 or do you plan to oust him?
This comes from the ECB. We're getting that cut to interest rates, as expected, 25 basis points. The deposit rate drops to 225 from 250. The estimate was 225. A range of headlines coming from the ECB, not pre-committing to a particular rate path. This is something we've heard repeatedly from the Governing Council and the Central Bank President, Christine Lagarde, not pre-committing. And how can you pre-commit when you don't know what the policy is going to look like elsewhere in the months to come? Joining us now to break this down is Lizzie Burden, live from Frankfurt, Germany. Lizzie, welcome to the programme. What do you make of the early headlines as they cross the Bloomberg?
Well, John, Donald Trump made this decision pretty much a no-brainer for the ECB, didn't he, with his tariffs, because the expectation is that they're going to weigh on euro area inflation and on growth. And we haven't seen a retaliation from the EU yet, so they haven't had to deal with the potentially inflationary impact of that retaliation. So given this was well priced, words are more important than actions today. And I'm waiting to see whether they drop this language about monetary policy becoming meaningfully less restrictive, because they added that at the last meeting. Dropping it would be a hawkish signal. And if they drop it, it would signal that maybe there won't be more cuts to come. So we just wait for that now. At the moment, traders have been pricing a 70% chance of a June cut. If Christine Lagarde at this press conference really goes to town on just how bad the growth hit is going to be, you could see traders thinking about a 50 basis point cut when it comes to that June meeting. But I also wonder, how much is she going to address euro-dollar strength head-on? Because, of course, it makes imports to the euro area cheaper, disinflationary. It makes exports out of the euro area more expensive, supporting that case to buttress growth.
Yep.
And traders are really going to be listening in for this, because today's been such a volatile day for the euro. I think it's the second most volatile on an ECB day ever in history.
Lizzie, you wanted that headline. It just crossed the Bloomberg terminal. They've dropped that word restrictive from the decision statement. I've got the statement in front of me. I just wanted to share this quote with you as well. On trade, the Eurozone economy has been building up some resilience against global shocks, but the outlook for growth has deteriorated owing to rising trade tensions. Increased uncertainty is likely to reduce confidence among households and firms, and the adverse and volatile market response to the trade tensions is likely to have a tightening impact on financial conditions. These factors may further weigh on the economic outlook for the euro area. Lizzie, what we've seen from a range of officials and from companies, particularly on this side of the Atlantic, is offering dual scenarios. Do you think that's something the ECB president could lean into in the news conference in the next 30 minutes?
I think the fact that they've kept the language about going meeting by meeting and data dependent shows, of course, that they want to hedge their bets at this point, keep their options open, not commit to a particular rate path. Because in an environment like this, John, they just don't know what lies ahead, do they? If you think about how much pressure there is on Christine Lagarde today, she's got to try and calm markets, though, because we haven't got a BOE decision this month. We haven't got a Fed decision this month. And you heard Jay Powell last night basically, of course, saying that you can't rely on the Fed for the Fed put. So it's a huge job for her at this press conference to calm them. But I am shocked that they have dropped that language at this meeting.
Lizzie, appreciate the input. Lizzie Burden there, Bloomberg's very own. Look out for Christine Lagarde a little bit later on this morning, 8:45 Eastern time, so in the next 30 minutes or so. If you are just joining us, the ECB reducing interest rates by 25 basis points on the deposit rate, widely expected. The rate was 250, it's now 225. Joining us now to discuss, Pooja Kumra of TD Securities. Pooja, welcome to the programme. I'm sure you've gone over the statement very quickly. What do you make of this decision?
As you said, I'm also surprised that they removed the word restrictive, but we also note that they have downgraded the growth forecast. They are worried about growth. And I think that was maybe a balancing act between, satisfying both the doves and the hawks. And I think we and markets know that in case of Fed, we have a challenge for upward risk to inflation and downward risk to growth. But when it comes to ECB, we have a downward risk to growth and inflation. If you look at the move in euro-dollar, you look at the move in oil prices, you look at the move in financial conditions, ECB is going to be below its inflation target than what they had expected in March. And I think that's very much obvious. And I don't think that ECB can actually turn their eyes with respect to that. And also when it comes to the general policy, they have told us 1.75 to 2.25 is kind of their neutral range. But I think when we think about neutral, we should also think about the circumstances behind that. And if things continue to deteriorate, especially what we saw last week, I think ECB has no choice but to continue with this series of rate cuts.
So, Pooja, they are acknowledging that the financial markets, financial conditions are doing the tightening for them, which is maybe something they've got to lean against. And there's also the prospect, I would say, of them and the continent needing to eat overcapacity out of China, which could be a big, big disinflationary problem down the road. Do you think that's the focus now? Do you think that should be the key risk that they focus on in the year ahead?
Yes, certainly. I mean, they have to find a mid-path between how to deal with the US as well as with China. And I think both ways, Europe is getting squeezed right now. The issue is that, does this retaliation turns up into negotiations? So far, when it comes to Europe, we have seen that they do not want to retaliate against Europe. And with respect to China, they're really not telling us any stance. I think at this stage, ECB, especially when as EU is concerned, they like a slower approach. So I think they are just trying to see how US and China evolves in the coming weeks. But I think they have just bought themselves time. In June, we will have the updated forecast, and which will show us a very grim picture if this uncertainty continues.
Pooja, take us inside the Governing Council. How wide do you think the range of views is?
So even, ahead of the Liberation Day, not everyone was expecting an April rate cut, right? We know that there are lots of ECB members that now are getting very careful as to how much they want to cut rates. So there is a lot of disagreement when it comes to this decision. But I think right now, even when you see the risk to the growth, Christine Lagarde herself has mentioned that a 25% tariffs in total could actually mean up to 1% hit to growth. And I think in that case, both doves and hawks will have to agree to the fact that they will need to cut rates. But I think a more effective tool here will be more from the fiscal side, i.e. we see more loan programs from EU, or ECB doing another TLTR or loan targeted program for banks. I think that is more of an effective way of actually supporting all the companies that will be getting hit by this additional tax, which is the tariff tax.
So, Pooja, you raised the issue of other policies which would be much more effective than the ECB. The ECB could end up pushing on a string yet again. How risky is it that other policymakers in Europe will slip back into the ECB is the only game in town, let the ECB do all the heavy lifting?
I think everyone expects it's a central bank that needs to do the heavy lifting. And same for the case of Fed. Everyone thinks that Fed will have to actually support the economy ultimately. I think they will need to find a balance here. For me, the key for ECB is how we stand on the financial conditions. Because, last week we actually thought that this is, when you saw the movement in credit spread widening, it's hard for ECB to ignore all these things, even if the hawks think that inflation is not in the right path. Because, what we are doing is the supply side and demand side both are getting hit with this entire shock. So I know ECB will be the key player of how things evolve. If they don't, the financial markets will force them to. But I think ultimately the key solution to target this issue will be a proper targeted support to these companies that will actually get the effect from the tariffs.
Pooja, I know people think that it's a joke, but in all seriousness, is the President of the United States basically deciding monetary policy over in Europe?
Unfortunately, not directly, but we can say indirectly, yes, right? The hit to growth, inflation, financial conditions, like whatever you talk about, it's got hit after the Liberation Day.
Pooja, we've got to leave it there. Thanks for dropping by. Important conversation. Pooja Kamran there of TD Securities nailed it. Last time the ECB met, we thought maybe they'd go on pause.
Yep.
We didn't know when the next interest rate reduction was coming or if it would come at all this year. I think people thought it might come maybe later on in the summer. Here we are now. This has changed, Mohammed, because of one reason. The announcement on trade on April 2nd.
It has. But, John, let me ask you a question. I can't remember the last time a federal official referred to the ECB. Can you remember any case of a US president referring to the ECB?
This is new territory.
Yeah.
Without a doubt.
What's so interesting is the president really wants the Fed to cut, but his policies has made it easier for the ECB to cut, which is the point he's making this morning.
And this is going to be the confusion. So if you're sitting here watching this programme right now and you're thinking, well, why is the ECB cutting in response to this? Why isn't the Federal Reserve? And I think the explanation is quite simple. The chairman at the moment is worried about the price effect. the ECB has to face something very, very different. And this is something we touched on in that conversation there. If the walls go up in the United States and you've got this overcapacity issue from China, and China exports all of that, and they only have one major destination to export it to, and it's not the US anymore, Europe has to eat it. The price pressures, the risks in Europe are way, way different versus the United States. You've got upside risk to inflation in the United States. I would say off the back of this, you've got downside risk to inflation in Europe, surely.
Yeah, but that's the wrong response, okay? If you're worried about dumping by other countries, monetary policies in there, I think I would
put tariffs up, don't cut rates.
A weaker dollar opens the door to other central banks to cut rates.
Are we going to see more of the same in emerging markets as well? This conversation is going to continue. Breaking jobless claims just around the corner. From New York, this is Bloomberg. The opening now 60 minutes away. Equity futures on the S&P just about positive by 0.5%. On the Nasdaq, higher by 0.8. In the bond market, your scores look like this: 2-year, 10-year and 30-year. Bond yield to higher by a single basis point across the curve. No drama here whatsoever. The 10-year, 429. The 2-year, 378. Jobless claims just around the corner. The estimate in our survey, 225. The previous number, 223. With an update, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we're waiting for the numbers to drop here. They haven't quite yet, but we do have housing starts down 11.4%. Get back to that in a minute because jobless claims are down 215,000. That's down from revised 224 last week. So there's no news in jobless claims other than what Jay Powell said yesterday. The labor market seems to be in reasonably solid shape. 1,885,000 continuing claims. That is up a little bit from 1,844 in the prior week. 546 federal workers filing for jobless claims. That category so far telling us nothing about what's going on in the federal government firing space. Back to housing starts, down 11.4%. Building permits were up 1.6%. It doesn't look like this was a particularly good month for housing, but every time you talk housing these days, you hear the hold music in the background. There isn't much to say about what housing's contributing to growth. The Philadelphia Fed is one that we really kind of care about today. It may be an unusual day where it's really important, but prices received for the Philly Fed at 30.7 versus 29.8. So more inflation in the Philly Fed numbers. If you're Jay Powell, why would you want to cut rates right now? The prices paid index there at 51, up from 48.3. So inflation in the Philly Fed numbers, Philly Fed overall at 26.4, negative 26.4, down from 12.5. So we are talking about a real collapse of confidence in the manufacturing area around the Philadelphia Fed. This is not good news for the Fed, and it makes the argument both ways. For the Fed. Cut rates because confidence has collapsed. Leave rates where they are because inflation is up.
And Mike McKee, in many ways, the conversation hasn't really changed. Soft data, not great. Hard data, OK. When you look at continuing claims, Mike, it's something that labour market economists have been referencing in recent weeks, that maybe there's evidence that once you're out of work, you can't get a job. What do you see this morning?
Not a whole lot of difference. I mean, what we see here is about a 40,000 increase. It doesn't tell you that there's any significant jump in the number of people who haven't been able to find work. And this number has gone up and down over the last couple of weeks. So labor market, as far as claims are concerned, is still showing the kind of strength it has been showing. And that doesn't give the Fed any reason to think that on a hard data basis, the economy is rolling over.
Mike, where are you on the debate of soft versus hard? Is it just a lag issue, 3 to 4 months, and then the hard data will reflect what the soft data, or is the soft data distorted?
The soft data is probably an indicator of how people are feeling at the moment because the headlines are all so bad. Will that carry through? Probably that depends, Mohammed, on what the president does. If he actually imposes higher tariffs and people see prices going up, they'll react. I'll go back to post 9/11 when consumer confidence cratered and then came right back up again, and people stopped spending for a little bit, but that recession was not a serious one because the country recovered fairly quickly from it. And do we see the same thing happen this time?
Mike, appreciate the update on the economic data there. Mike McKee, equity futures still positive by 0.6% in the bond market. Not much of a move, some stability here. Yields are up at the front of the curve by 0.1%, or rather 1 basis point. We're higher to 378. I'm getting tired. Yields unchanged on a 10-year, 428. Well, to turn to foreign exchange, and we'll talk about percentage point changes. Euro-dollar negative by 0.4%. Euro-dollar down to 115.30.51. The ECB rate decision out just moments ago, cutting interest rates once again, Mohammed, by 25 basis points. They seem to be in a very different position compared to, say, the Federal Reserve and Chairman Powell.
They are. They are at the opposite end of the Fed, and the Bank of England is in the middle of that distribution. But the press conference will be key here, because how President Lagarde conveys the inflation dynamics, not just the growth dynamics. I think the growth dynamics are clear, but the inflation dynamics is going to be very important.
I couldn't agree more. The ECB president kicking off that news conference in about 11 minutes' time. The New York Fed president, John Williams, speaking at the moment, just said this: the economy is in a very good place. Lauren Goodwin of New York Life joins us now for more. Lauren, can I ask you, is the economy in a very good place?
I think the economy is in a pretty precarious place, but we're starting from a really strong base. Our economic scenarios coming into this year, we expected growth to slow from around 2.5% to just below 2%. We're now looking at 0.5% of GDP growth out of the U.S. this year. So it's not a recession, but that's a much more worrisome position, let's say, than we expected just a couple of months ago. And perhaps more important than that, though we have about a 50-50 percentage on recession versus not, we're pretty confident that we'll end the year with inflation higher than it is. And so as I see investors look around and say, maybe we'll wait and see how tariffs develop, see how monetary policy developed, I look at that expectation for higher inflation and I say, even if you were going to wait and see, do you have the portfolio that you need to wait and see when we have such inflation volatility?
Let's get into that in a second and just focus on the economy and monetary policy, and then we can get to the market calls. If you think that growth's going to come down from 3 to 0.5 and inflation by the end of the year will be higher than now, Chairman Powell is not giving us any clues on when he'd reduce interest rates. When do you think he'd reduce interest rates, if at all?
I think that the Fed will do as much as it can to do as little as possible. It's just very difficult to change policy credibly in a position where inflation expectations are so on the line. I completely agree with Mike that short-term inflation expectations that we're seeing out of consumers, out of businesses, have de-anchored in a meaningful way in reaction to how people feel right now. I expect that those will come down as reality proves to be less dire. But we're still in an environment where, in order for the Fed to avoid some of the worst case scenarios for the economy, cutting rates doesn't get you there. I don't think cutting rates does much to shore up supply chain challenges. Cutting rates certainly doesn't do much to manage inflation expectations in both short and long-term market interest rates. And so they're going to do everything they can not to move.
So your base case is stagflation?
Stagflation light, where you have a little bit of growth, but inflation moving up. And the difference between being in recession and not in recession, I think, is meaningful for the markets. But when we're looking at the economic scenario, not a whole lot of daylight between a sort of muddle through with inflation as opposed to an outright recession. Our lowest probability, about 15%, is for a recession that's deep enough and demand destruction is pronounced enough to actually bring inflation lower. I think that's the least likely scenario.
You mentioned things like trade and supply chains. The president was out this morning with a few different social media posts, but one of them was about the fact that he talked to Mexico, he talked to the Japanese negotiators. He says even China's waiting to come in. The Italians are here today. What if all these trade barriers and concerns are actually solved within 90 days?
For one, I think it's very unlikely, and expect that the average tariff rate will be higher in a couple of months than it was a couple of months ago, which has a meaningful impact on inflation. But perhaps more important, tariffs are a negotiating tool, but they're also a policy in themselves. We've been hearing from the administration that trade deficit is perceived as a sign of global economic weakness, and it's a challenge that the administration is looking to resolve. On top of that, if the goal of those policies in the end is to reshore some important supply chains, How far that goes remains to be seen. But even so, that's a very capital-intensive trend that, frankly, even if tariffs were completely rolled back and we shook our hands of the last couple of weeks, those capital-intensive trends are happening. They're underway. And so I see that as an environment where outright disinflation is unlikely.
So, Lauren, you teased the portfolio implications of everything we just discussed at the beginning of the interview. So what are they, and how far are investors from where you think they should be?
For starters, the 60-40 portfolio, and look, not all investors use it, but just as a baseline, the 60-40 portfolio was designed for a period where inflation and inflation volatility were low. That's not the situation that we're in right now, and so it's not the benchmark probably that investors should be using. For two, if you think about the last 15 years, the most effective asset allocation, if we're all honest with ourselves, would have been to be 90% invested in U.S. large cap growth equity. We got a couple of extra years of that, even as inflation rates have been higher because of the boom from AI. But as I look forward, I don't think that that's the allocation, that overweight U.S. equity allocation, that makes the most sense moving forward. So geographic rebalancing, I think, is important. We're definitely seeing that out of ex-U.S. investors already. I think U.S. investors need to do the same. We're also looking at building inflation resilience, whether that's in dividend payers or income generating equity, or by taking equity-like risk in credit or in the bond market. And we're considering some hedges for inflation volatility, those moments when you get inflation surprises, so including gold, real estate, other inflation-aware asset classes. So
the one thing you didn't mention is government bonds. You completely avoided government bonds. So let me take you there. What about government bonds?
So I have very high conviction that duration is a tactical bet at best for the foreseeable future. Now, we know that taking the 10-year Treasury bond as an example, there are three things that move the 10-year Treasury. The path of the Fed funds rate over that 10-year period, we're not seeing a lot of price expectation or changing there. Inflation expectations, which have been pretty well anchored, but there's a wide dispersion of estimates so that it moves a little higher. And then the term premium, supply and demand issues. And not only in moves in the 10-year, but also in moves in currency, tell us that demand for treasuries is fraying a bit on the margin. And that makes sense to me, given what we're seeing globally. So that's an environment where I think the 10-year treasury yield is absolutely live between 4 and 5%. So if you can be in the market tactically and trade those moves, sure. But for the average investor that's making, 1 month, 3 month, 2 year changes, duration is not our favorite place to take risk.
Lauren, appreciate the clarity. It's good to see you. As always, thank you. Lauren Goodwin there of New York Life. Just finishing up there on the bond market. The bond market at the moment looks like this. Yields higher by a single basis point across the curve, up by close to 1 on a 10-year to 428. At the front end of the curve, 378. That's the price action. In just a moment, 5 minutes away from a news conference with ECB President Christine Lagarde following an interest rate reduction of 25 basis points. With an update on stories elsewhere this morning, here is your Bloomberg Brief. Recapping the data out just moments ago. Initial jobless claims falling to the lowest level in 2 months, coming in lower than expected at 215k. Continuing claims rising to 1.89 million, slightly higher than estimates. Elsewhere, the ECB cutting rates by 25 basis points, citing a deteriorating growth outlook thanks to rising trade tensions. President Lagarde speaking momentarily. We'll bring you those remarks live right here on Bloomberg. And finally, Nvidia. In the crosshairs of US-China trade tensions, the CEO, Jensen Huang, in Beijing after the Trump administration curbed the sale of its H20 chips to the country. Huang is reportedly meeting with clients, including the founder of DeepSeek. And that right there is your Bloomberg Brief. Up next, we'll set you up for the day ahead and we'll catch up with ECB President Christine Lagarde. We'll take those comments live from Frankfurt, Germany. That argument at the commercial break was better than anything that's been on this morning. Do you want to continue? You good?
We don't agree on a
We're
few
live
things this morning.
Counting you down to the opening bell, 45 minutes away. Nice. Equity futures up by 0.6% on the Nasdaq, up by 0.9. Your trading diary looks like this. Today, President Trump meeting with the Italian Prime Minister Giorgia Meloni, and Netflix earnings coming after the closing bell tomorrow. Markets close for Good Friday next week. Earnings season ramping up with results from Tesla on Tuesday, Wednesday Boeing reports, and we'll get some PMI data Thursday, durable goods, and another round of jobless claims. And the President of the United States no doubt will have a few things to say on trade along the way. In just a moment, we'll have an ECB news conference for you with ECB President Christine Lagarde. Seeing live pictures out of the corner of my eye. That's just commencing. When it starts and she starts to address people, we'll take that for you. But enough time for a final word around the table. A final word on a pretty interesting morning going into a long weekend.
I think the President's going to have a lot to say on trade today, but also he's going to be asked about these words regarding this, quote, termination cannot come fast enough for the Fed Chair Jay Powell. What does he mean by termination? The end of Powell's term next year, May? Or can he do something? Can he oust Powell? And the reason why I think this is an important moment is because the context of the Supreme Court basically giving the president the leeway to oust two top officials at independent agencies. And this is where I think me and Mohammed differ a little differently about what is going on in this moment right now.
I would just generalize what Anne-Marie just said and refer back to what I think is just one of the best headlines I've seen, which comes from Justin Fox's column in Opinion. Economic uncertainty has never felt this uncertain. I think that is such a powerful sentence.
I'm going to finish the week with some good news. In the bond market, some stability. There was great fear over the last week about a loss of safe haven status in the United States of America. We're ending the week with some stability, and let's hope it stays that way. The bond market pretty much unmoved. A special thanks to Mohammed Al-Arian for the last 2 hours on this programme. To you as well, Anne-Marie.
Thanks.
To Bramo, who's already getting ready for the long weekend. Thanks to Lisa as well, as always. Let's head over to Frankfurt, Germany, and hear from the ECB President Christine Lagarde following a 25 basis point reduction in interest rates.
Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, the disinflation process is well on track. Inflation has continued to develop as staff expected, with both headline and core inflation declining in March. Services inflation has also eased markedly over recent months. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Wage growth is moderating, and profits are partially buffering the impact of still elevated wage growth on inflation. The euro area economy has been building up some resilience against global shocks, but the outlook for growth has deteriorated owing to rising trade tensions. Increased uncertainty is likely to reduce confidence among households and firms, and the adverse and volatile market response to the trade tensions is likely to have a tightening impact on financing conditions. These factors may further weigh on the economic outlook for the euro area. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of exceptional uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So the economic outlook is clouded by exceptional uncertainty. Euro area exporters face new barriers to trade, although their scope remains unclear. Disruptions to international commerce, financial market tensions, and geopolitical uncertainty are weighing on business investment. As consumers become more cautious about the future, they may hold back spending as well. At the same time, the euro area economy has been building up some resilience against the global shocks. The economy is likely to have grown in the first quarter of the year, and manufacturing has shown signs of stabilization. Unemployment fell to 6.1% in February, its lowest level since the launch of the euro. A strong labour market, higher real incomes, and the impact of our monetary policy should underpin spending. The important policy initiatives that have been launched at the national and EU levels to increase defence spending and infrastructure investment can be expected to bolster manufacturing, which is also reflected in recent surveys. In the present geopolitical environment, it is even more urgent for fiscal and structural policies to make the euro area economy more productive, competitive, and resilient. The European Commission's Competitiveness Compass provides a concrete roadmap for action, and its proposals, including on simplification, should be swiftly adopted. This includes completing the Savings and Investment Union, following a clear and ambitious timetable, which should help savers benefit from more opportunities to invest and improve firms' access to finance, especially risk capital. It is also important to rapidly establish the legislative framework to prepare the ground for the potential introduction of the digital euro. Governments should ensure sustainable public finances in line with the EU's economic governance framework and prioritise essential growth-enhancing structural reforms and strategic investments. Annual inflation edged down to 2.2% in March. Energy prices fell by 1% after a slight rise in February, while food price inflation rose to 2.9% in March, from 2.7% in February. Goods inflation was stable at 0.6%. Services inflation fell again in March to 3.5%, and it now stands half a percentage point below the rate recorded at the end of last year. Most indicators of underlying inflation are pointing to a sustained return of inflation to our 2% medium-term target. Domestic inflation has declined since the end of 2024. Wages are gradually moderating. In the last quarter of 2024, annual growth in compensation per employee stood at 4.1%, down from 4.5% in the previous quarter. Rising productivity also meant that unit labour costs grew more slowly. The ECB's wage tracker and information from our contacts with companies point to a decline in wage growth in 2025, as also indicated in the March staff projections. Unit profit fell at an annual rate of 1.1% at the end of last year, contributing to lower domestic inflation. Most measures of longer-term inflation expectations continue to stand at around 2%, which supports the sustainable return of inflation to our target. Let's look at the risk now. Downside risks to economic growth have increased. The major escalation in global trade tensions and associated uncertainties will likely lower euro area growth by dampening exports, and it may drag down investment and consumption. Deteriorating financial market sentiment could lead to tighter financing conditions, increased risk aversion, and make firms and households less willing to invest and consume. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, also remain a major source of uncertainty. At the same time, the increase in defense and infrastructure spending would add to growth. Increasing global trade disruptions are adding more uncertainty to the outlook for euro area inflation. Falling global energy prices and appreciation of the euro could put further downward pressure on inflation. This could be reinforced by lower demand for euro area exports owing to higher tariff and a rerouting of exports into the euro area from countries with overcapacity. Adverse financial market reactions to the trade tensions could weigh on domestic demand and thereby also lower inflation.
गाइस मार्केट को देखोगे बिटकॉइन और इथेरियम दोनों ही साइडवेज कंप्लीट साइडवेज का भी साइडवेज है 15 मिनट के लेवल है ऊपर ही नहीं आ रहा है मार्केट क्लोज है देखते हैं मोमेंटम होता है तो दोनों साइड से सपोर्ट रेजिस्टेंस सेम फॉर इथेरियम विद बिटकॉइन बाकी के लेवल तो हैं 15 मिनट की
This episode is brought to you by the number 4.33%, which is the so-called federal funds rate. It is the interest rate that the Federal Reserve pays the most attention to, so they target a certain band. They will target, for instance, right now, 4.25% to 4.5%, and then the market trades within this band, and right now it's 4.33%. I say all this because everybody wants to know, is it going up or is it going down? Is the Fed going to cut rates more? Very unlikely that they're going to hike them, but that's also on the table depending on how you game things out. So what's your thinking with regard to the Fed?
Yeah, our firm view is that we're going to see 2 cuts this year, and the Fed is in a tight spot. Because on one hand, there's uncertainty about economic growth, and most likely it is moderating. What we don't know is the scale of that moderation. On the other hand, inflation is proving to be sticky. In fact, the most recent inflation print was a little higher than what the market was expecting. That combination is not what's going to get the Fed to start cutting. Now, if you see the labor market start cracking, in other words, unemployment going up meaningfully, and economic growth simultaneously slowing a lot, then the Fed is probably likely to be more aggressive in cutting rates. They have enough capacity to do that. The problem is those cuts are for the wrong reason. In other words, it's not just
markets
inflation.
Don't like those cuts.
Yeah,
exactly.
Bad news.
It means that growth is at serious risk, and they are really trying to contain the problem on the downside. So that's not a great environment for earnings or for equities, at least as it's happening.
And you talk a lot about these uncertainties. Obviously, all of that has weighed on markets, especially through the first 3 months of the year. But we did come in pretty hot, especially with the tech. There's a lot of talk that we were overvalued. Given this sell-off, do you still think we're overvalued?
No, I don't think we're overvalued because all the correction we have seen thus far is one of the most significant derating we have seen in equity markets since the 22 sell-off. And that 22 sell-off also, if you remember, was very tech-centric.
It was brutal.
And especially big tech-centric. Mm-hmm. So what has happened now, to give you some numbers and context, is big tech, which is essentially a group of 6 stocks, right? Which are almost 30% of S&P. They drove more than 50% of S&P returns the last 2 years, and they account for 25% of S&P earnings. So it's a very important component of the market. That group was trading at 31 times forward earnings at the beginning of the year. In the middle of last year, they were trading at 34 times. So in other words, it's corrected 3%, so 10% at the beginning of the year. Now we're sitting at 24, 25 times.
Wow.
That is a 20, 21% correction already. And for a group whose earnings are moderating, but are still likely to settle in the 16 to 20% range. So earnings still relatively robust, significant derating. They're trading at 24, 25 times. But is there more downside risk? Maybe, because the bottom they hit in 22 sell-off was 22 times, right? So I think, but my view is that a good part of the valuation story is already telling you that a lot of the risk is priced in. And I do expect earnings to start adjusting downwards going forward. And we just have to hope that this tariff uncertainty in the next 3 to 6 months clears, in which case the market will stabilize and we can end up seeing some recovery towards the end of the year.
Thinking about the markets from a sector perspective, we have, as you were just detailing, all these statistics with regard to how big the market has relied on these 6 names, arguably a 7 at times, but these 6 names. The rest of the market has stepped up a little bit, but we're seeing defensive sectors like staples, consumer staples, utilities, real estate at various times, healthcare has been leading. It's been propping up the bull market. So we only saw the S&P 500 go into correction, down 10%. The bear market, by popular definition, is 20%. But you know, I got to think that this bull market has kind of been premised on the AI trade. How much does it need to reassert to get the S&P 500 back to those record highs?
I think it's a little bit complicated. There are 2 levels to it. If you think about what was keeping the market going for the last 2 years, were 2 key pillars. One was the strength of consumption in the consumer, and the second was the exceptionalism of US tech, specifically big tech. Right now, both those are weakening. So with big tech, their earnings are moderating, but their multiples have come down a lot. But the market has been focusing a lot on the scale and the level of their capital spending. And it's getting anxious about when they'll start monetizing this massive capex spend.
Well, we got a runway showdown to hit that on. Yes, in a little bit.
We're not there yet, but that's where the market is intensely focused on. And on the consumer side, the problem is, given the sticky inflation, given the policy uncertainty, given the DOGE-related sort of cuts, all that is leading consumers to start scaling back on their spending, right? So both those premises have weakened. In terms of the broadening, to your point though, this recent correction, 10% from the peak, whatever we have seen, has been largely focused mainly on tech, especially big tech. The rest of S&P has not corrected quite significantly. And so they have buffered to some extent the market. But our view is that if things go wrong, then the rest of the market is not immune.
They catch down. Right. They don't catch up, they catch down.
Yeah, in fact, when we cut our earnings number, it is for the rest of S&P outside of tech, where we were expecting them to grow about 3.5% in earnings. Now we think they declined roughly 0.5% to 1%. Now, if things get worse on tariffs, it'll be a lot more than that, right? So I think we are not necessarily so let me put it this way. We are in a precarious environment right now, mainly because of what I almost feel like it's a self-inflicted problem.
It's my fault.
Driven by the scale of policy uncertainty.
Policy uncertainty, but we did see the DeepSeek news to kick off the year, which sort of started this anxiety, I guess, around the tech trade and how frothy that market was. Does that worry you at this point, or have those fears sort of been pushed aside and now it's kind of all the focus is on the administration?
No, the DeepSeek information was a big catalyst. I agree with you. And that was one of the reasons why the correction started, but then recovered. The point over there is, in the big scheme of things, I think it's important. It will force the big tech companies to be more careful about how they're deploying their capital. And I wouldn't be surprised if they start moderating that capital spend down the line.
Which could be a good thing from an investor perspective.
Right. What we really want, the success of AI ultimately depends on applications growing quite significantly, right? And when that happens, it means that you will start seeing the productivity impact also on the broader economy. And what is happening right now is that the pace of adoption is still relatively modest, but it's picking up fast. Like if you look at even OpenAI, their consumer base has increased well over 30% in just the last 2 months, right? So I think it is beginning to happen, but it doesn't mean that we are clear from everything is good. But DeepSeek in the big scheme of things, I think it's a wake-up call. But I'm not too worried, because the end of the day, the center of gravity for innovation and growth and the ecosystem and the dynamism is in the US tech industry. And that's why I remain incrementally positive on big tech, even though I say that in the short term, there are no clear catalyst for them to start rallying again. But once they post decent numbers and the tariff uncertainty clears, I think they will work fine.
Perfect segue for today's runway showdown, which is lit with the glow of GPUs and data centers, but which is a look of the future. First down the catwalk, we have monetization mode, draped in sleek margins and wearing custom-tailored earnings beats. Monetization struts with confidence and ad revenue is back. Cloud margins are improving. The enterprise is on board. AI is finally paying the bills. Microsoft and NVIDIA, they wave from the front row. But stalking in right behind is CapEx chic, a challenge to monetization mode. This look is bold, capital intensive, it's high fashion, but also low cash flow. Think data centers, power-hungry chips, and eye-watering build-outs that don't yet print profits. CapEx chic isn't interested in your forward PE. She's interested in tomorrow, even if Wall Street doesn't foot the bill. And watching it all from the sidelines is the skeptical bull. He loves the narrative, hates the multiples, but believes in AI, wondering if it's already baked into the price. So Venu, help us out, help the skeptical bull and all of us make up our minds. Who is wearing the future of AI better? Is it monetization mode or CapEx chic?
I would say that I would stick with the monetization mode. I think it is going to happen. It'll probably take a little longer. And though I am somewhat skeptical about the level of enthusiasm on the scale of the productivity improvement and monetization, but I do think it's going to happen. And I think capital spending, I'll give you one very interesting statistic. One of the things we looked at was last year, in 2024, S&P companies spent almost $775 billion in stock buybacks. Big tech as a group accounted for over a third of that. So think about it. If they just stop spending on buybacks, it'll fund almost all of their CapEx for this year, right? So my point is, big tech capital spending is very high. It's self-funded. It is being funded by their mature businesses, which make a tremendous amount of money, which are high-margin businesses. They are facing idiosyncratic risk for sure, and it's a show-me story on monetization. But I think eventually we'll find the right spot. I just hope that the worst-case scenario is that all this capital spending was not worth it. I don't think that's an extreme example.
Yeah, I think it's going to be found to be worth it too. And unfortunately, we have to leave it right there. We have wound things down here at Stocks in Translation. Make sure to tune in next time for another episode.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Welcome to Financial Freestyle. Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Yahoo Finance Sports Report.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
D.R. Horton sounded the alarm on housing demand in its recent earnings report. The home builder cut its full-year outlook, citing a slower than expected start to the home buying season, as would-be buyers remain cautious. Here to discuss the spring home buying season, we've got Adam Pretorius, who is a real estate agent with Lepich Kroger Realtors working in Iowa City. Good to have you here with us, Adam. Would you agree with D.R. Horton's characterization that the spring home buying season has been off to a slow start?
Well, here in the Midwest in Iowa, we're seeing actually an increase in sales. I mean, we just came off last year, one of the worst years we've had in many decades, where we were at an all-time low, sales had declined. But this year we've seen a 10% increase. But I think buyers are becoming more picky. They're choosing between their options much more, and new construction has had such a large increase in costs that many are looking more towards resales.
And so, let's talk about inventory. Census data showed new residential construction in March. It fell by the most in a year. What are you seeing in terms of supply and demand in today's market?
So it's still a complete mismatch, right? That is the biggest problem in real estate is we just don't have enough supply to meet the demand. And that goes for both rentals and for purchases. Those are your two options when it comes to housing. And that is creating much of the issue with pricing. I mean, we've seen prices even last year with the sales going down. We still saw prices go up 7%, which shouldn't have occurred. You'd expect the opposite. But this year we've seen prices still increase another 10% off that. So prices are probably the biggest issue, which is just a product of that mismatch of the supply and demand.
Now, you tend to work on the more luxury end side of the scale here, higher cost luxury homes. Have you found that the traffic in your area, what have you been able to make of that? Is it folks upgrading their house or people relocating to Iowa City from other places in the U.S.?
Yeah, I mean, during the pandemic era, we saw a surge in people doing much more remodel projects. And now we've kind of seen that pull back a little bit. The new construction has softened in the luxury market. We haven't seen quite as much new construction sales as we did during the pandemic. But we're seeing a little bit of a resurgence in that luxury market locally. But the days on market for new builds is much higher than it has been, say, during the pandemic in the last 4 years. And the capital that people are able to get, for builders to get rather, to do these projects has tightened up as rates have gone up. And not only is it harder to get capital, but when you do get capital, we're now seeing, the cost of capital anywhere from like 9 to 10% on these loans, which is double what we saw during the pandemic era. So builders are having to pass those costs on, and most of construction is cost plus pricing. So we just see those prices increase, and it makes it much more challenging, I think, when a buyer's faced with the option to buy a new or a resale, to go for new when those costs keep going up.
You shared 3 strategies for sellers in this environment: pricing, timing, and positioning. Could you break those down for us?
Yeah, I mean, every market is their own local sport. So every market's going to have different market cycles. And you should really work on timing. That is such a big product of pricing. We always focus on pricing, but we don't think about timing as much. So locally, for example, I have a spring and a fall market. Our slowest time of the year is August, July, and June in that order. So if you're a seller, it doesn't make sense to go on during a slow market. You really want to make sure that you time things ahead of time. And then positioning, because positioning is what we make value propositions on as buyers. It's what your house is versus another house is worth. And that's often what we see on new construction too, because resales are a product of the cost to build new. And so resales are a discount of new construction. And so more people will flock towards resales if the discount is enough versus the cost to build new.
Yeah. Following on that positioning comment, you mentioned the power of social media in today's market. What should sellers look for in their agents' Instagram or TikTok as they're looking to try and make sure that they're kind of meeting people, meeting buyers, where they're spending the most screen time?
Yeah, this is totally crazy to me. But we went from using the book pre-century, where every brokerage had their own book before the digital age, and then we went to the internet, and the internet sold real estate, and now social media is selling real estate. So it's no longer just going to look for your agents present online, their website. Go check out their handle, their profiles, their social media strategies. What is that presence? There's a reason why so many companies are putting so much money into social media, and that's because it sells products. It also sells real real estate. And so make sure that the agent that you hire has a good social presence, that they're actually able to broadcast you to channels, because social media reach is such a bigger market, not just your local, but maybe it's relocation buyers from outside of town or across the US or internationally.
A new study from student loan company College Ave found less than half of college students kept a personal budget while in undergrad. Whether you're in the majority who have never kept a budget or a parent looking to prepare your child for the real world, don't worry. As part of our theme week, the class of 2025's financial playbook, we're getting back to the basics of budgeting. Here to help, we've got budgeting expert Andrea Warrock. Great to have you here with us. Okay, so first, let's just start basic, perhaps. What advice would you give someone who's never had a budget before?
Well, thank you for having me. Well, a budget is such an important tool to help you reach your financial goals. And the most important thing that I want any viewer and thinking right now is to reframe the way you think about a budget. A lot of people look at budgets as being restrictive, not allowing you to live your best life, not allowing you to enjoy certain expenses or purchases. But the reality is a budget can give you flexibility and freedom. It allows you to really pay attention to where your dollars go, so nothing is being wasted. And, you know, that just allows you to be more allows you to really create the lifestyle that you want. And so to begin with your budget, you really need to figure out, are you living within your means? Are you spending more? So write down your take-home pay, list out all your expenses, your necessary expenses, plus maybe an average spend on those expenses where they are, you know, fluctuating from month to month. And then this gives you a snapshot of how you're spending. And now you can begin creating a plan to cut back in the areas where you're overspending. Remember, you cannot change what you can't see. So writing it all out on a piece of paper or an Excel chart is a great place to start. And of course, there are budgeting apps as well that can help you out.
Right. And so if you're looking to build a budget that will last, what are some ways that people can stick to their personal finance plan?
Right. Okay. So first of all, maybe determine what kind of budgeting method works best for you. There's a rule called the 50-30-20 rule. And this assigns 50% of your expenses towards those necessary bills like rent, mortgage, healthcare, gas, food for groceries, 30% to the lifestyle expenses like entertainment, vacation, gym memberships, and then 20% to savings. I like to save before I pay any of my bills, so I know that I'm reaching that goal. Now, the most important thing to sticking to your budget is making sure that you are actually paying attention to where your money is going. And so I mentioned budgeting apps are a great tool to ensure you're sticking to your plan. I like Rocket Money. There's also You Need a Budget or Pocket Guard. All of these link all your financial accounts in one place. So if you have multiple credit cards, a checking account, savings account, you can see it all in one place. And this way you really know where your money is going, that you're sticking to those spending categories that you set for yourself. And also, you know, this doesn't mean you can't spend on certain expenses, but just be really savvy on how you are spending. Make sure that you're comparing prices, make sure that you're applying coupon codes when possible, and then also shop at stores that offer affordable options. I like stores like Dollar General. They post thousands of items in their Value Valley that cost just $1 or less. And you can access this through their app. And this is going to be for groceries, personal care items, healthcare items. This could really help you stretch your dollars, stick to your budget. And this is a good tip for anybody out there who feels like, well, they're being deprived, like, you know, they don't want to cut out all those Starbucks purchases or maybe, you know, going to the movies and those types of things. Tap into the free rewards that you get from credit cards, retailers, or even apps. This is a great way to indulge in a splurge without derailing your budget. Yeah. So for instance, make sure you're using a robust cashback credit card. I like the Bread Rewards American Express credit card because it offers 3% back on groceries, gas, dining out, and your utilities. So you're paying for those things anyway, earn that cash back. And then also use an app like Fetch. This is a rewards app that will give you points for all your purchases when you snap a photo of your receipt. Then you could redeem those for gift cards to Starbucks, Sephora, Amazon, and then indulge in a splurge, again, without derailing your financial goals.
Just briefly, I got about 40 seconds here. What advice do you have for parents of soon-to-be college graduates who want to talk to their kids about setting up a budget?
Yes. So I think it's really important to talk with your soon-to-be graduate about what their goals are. Are they planning to try to find an apartment to live on their own? Are you going to help them out by allowing them to live at your own home? Even if they are living with you while they look for a job, this could be a good opportunity for them to get a little bit of experience of what it's like in the real life. Maybe you could charge them a small rent. Maybe they can contribute to the household bills. Sit down with them and show them what different things cost so that they could start preparing for that reality in the future that's yet to come. Also, this is a good time to also start thinking about student loans. When are those repayments going to be in effect, and making that part of the plan as well.
Andrea, thanks so much for taking the time here with us. Really appreciate it.
Thank you for having me.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Good Morning Brew Daily Show. I'm Neil Fryman.
And I'm Toby Howell.
Today, President Trump said Jerome Powell's termination can't come soon enough. But can he fire the Fed chair?
Then Netflix is looking like the calm within the tariff storm. It just reported some tasty first quarter earnings. It's Friday, April 18th. Let's ride.
Good Friday morning, everyone. And I mean that literally because today is Good Friday. That means the markets are closed for the holiday and many of you are looking ahead to the Easter weekend. If there's one thing clouding Easter celebrations this year, it's the price of eggs, which are up about 60% compared to a year ago. Some companies are offering less budget-busting alternatives. Jet Puffed Marshmallows released a color dyeing kit as a festive, mess-free twist on egg decoration for $2, which includes 6 colors, decorating pens, and of course, a 24-ounce bag of marshmallows. Toby, what would you draw on a marshmallow?
I would draw an impression of the roof of my mouth because I am eating those things, Neil. Definitely a 2-to-1 ratios of marshmallows decorated to marshmallows consumed. But this trend of finding ways to have some Easter fun without eggs is a fun one. Some moms in a Facebook group were dyeing potatoes and passing them off as eggs. Not as delicious, but also cost effective. Also rocks, literal rocks. Definitely not as fun to eat as marshmallows, but still, most of the appeal of dyeing eggs is just the tradition of it and that you do it with your family. So as long as you keep that going, it doesn't matter if it's actually an egg or a rock or a marshmallow. And now a word from our sponsor, Planet Oat. Neil, you know how some actors just own every scene they're in?
Oh yeah, it doesn't matter if it's a rom-com or a courtroom drama. They walk on screen and boom, you're just locked in.
That's what Planet Oat does for your breakfast or your coffee or your smoothie. It steps in and suddenly everything becomes richer, smoother, more sophisticated.
Planet Oat was born to be in the spotlight. Just its velvety texture alone shows its A-lister material.
Heck, even the unsweetened version with 0 grams of sugar still tastes like a leading role.
And it's dairy-free, gluten-free, soy-free, all the good stuff with none of the drama.
If your morning routine needs a little star power,
Planet Oat is sitting in hair and makeup waiting for its big screen moment.
Get your hands on the oat milk that has it all. Visit planetoat.com for more.
Call me a monopoly once, shame on you. Call me a monopoly twice, well, that just makes me Google. For the second time in less than a year, Google has been deemed a monopoly in court after a district judge ruled that Google acquired and maintained an uncompetitive advantage in the market for ad technology. It's another victory for the DOJ in its crusade against big tech's power, and another stinging defeat for Google, which could see large aspects of its businesses hived off or impeded. Google was already found to monopolize the search market last year. The case decided yesterday concerned the largely invisible but incredibly important ad tech tools that power the internet, essentially the inner workings behind why you see an ad on a web page. The DOJ accused Google of monopolizing 3 separate markets within ad tech, which allowed it to collect monopoly profits from publishers and advertisers who had no alternative while ultimately harming end consumers. The judge agreed on 2 out of the 3 markets. Yes, monopoly on publisher ad servers, which is how publishers sell ad space on their sites. Yes, on the market for ad exchanges, which facilitate ad buyers and sellers, but no monopoly on the ad networks used by marketers. A little in the weeds for sure, but TLDR, Google is not feeling lucky.
Yeah, let's just dive into the weeds a little bit because it is confusing. This case is about how Google dominates online ad sales. So it's not the ads that you see in Google search. It's the ones you see just across the rest of the internet, really. It focuses specifically on its role in this digital display ad market and the behind-the-scene tech that powers those things. So what is being challenged here is their dominance in the publisher side ad tools. What's not being challenged is their search advertising business, which accounts for 90% of its overall revenue. Still, that is a sizable revenue chunk that is up for debate here. It accounted for 10% of its revenue last year, $10 billion worth. So it's not nothing, but it's not necessarily this existential thing. But yeah, when you add up the 2 latest monopoly rulings, Google is feeling like, God, we can't catch a break here for at least initially speaking.
Yeah, I mean, they said they are going to appeal the third of the ruling that they lost. Google spokesperson said, "We disagree with the court's decision regarding our publisher tools. Publishers have many options, and they choose Google because our ad tech tools are simple, affordable, and effective." Just like their argument in the search case, where the vast majority of people use Google search, their argument was sorry for being good. And the other accusation of the DOJ here was that not only do they have these, very powerful ad tech tools, but they warp them together into an ecosystem that entraps people and publishers and advertisers and doesn't allow them to leave the ecosystem. So it's this integration that regulators were also after. Again, Google pushes back and says that all this integration leads to more affordability, more usability. Obviously, those arguments fell on deaf ears.
Yeah, specifically what you're describing there is it breaks antitrust law by engaging in a practice called tying, which is forcing customers to use one Google product in order to get access to the other. And so that was one of the things that set off warning bells and caused the judge to rule like they did. So looking ahead here, how does Google kind of navigate these rocky waters? Like most of big tech, Sundar Pichai, Google CEO, has been kind of going on this charm offensive with President Trump. He attended his inauguration, and then just last week, Trump told reporters, "I love Google." So it does seem like there is a little bit of love coming from the White House, so that may potentially influence how this case happens. But still, second time in 8 months that the company has been deemed a monopoly in court. The next big thing to look out for on Google's calendar is not your actual Google calendar. This is Google's actual calendar. They are a case for the remedies of that initial monopoly case begins on Monday next week. So we'll probably give you an update on what is at stake there. That could mean shaving off Google Chrome, which is a big part of its business. So yes, a very crowded calendar when it comes to monopoly cases if you are Google. Jerome Powell and President Trump's beef reached new levels yesterday as Trump explicitly called out the Fed chair in a post on Truth Social. Trump wrote, "Powell's termination cannot come fast enough," explaining that Powell is always too late and wrong when it comes to cutting interest rates. What set off Trump's tirade? A speech given by Powell in Chicago the day before, where he warned that the size and scope of the trade agenda Trump was pursuing could lead to higher inflation and slower growth than initially expected. It's left the Fed in what Powell called a challenging scenario. If the Fed leaves rates where they are to restrain inflation, it could worsen the job market. The same goes for vice versa. If it tries to stimulate the economy with a rate cut, it could send inflation skyrocketing again. So, Neil, this war of words is also heading to the courts with the fate of Fed independence on the line.
Economists across the board, both on the right and the left, warn that reducing the Fed's independence could send markets tumbling, even more volatile than they are now, because the Fed is supposed to be independent so it can think long term. Political people in political office have these 4-year terms. They think in a very short term scenario. So yes, President Trump, like many other presidents, probably want lower rates because that causes the economy to go faster. But if you're Jerome Powell, you are looking over the long term. You are not elected by anyone, so you can keep rates higher because of the inflation threat of what happens when you lower interest rates, which is why Politico reported that Treasury Secretary Scott Bessent, he said he's been working behind the scenes cautioning President Trump and White House officials to say, look, this is something you don't want to mess with. He has previously said publicly the Fed independence is the jewel box that has got to be preserved. So he's pushing back on this within the administration, saying this is just a line you can't cross or else investors will lose faith in the entire system.
Right, and this goes back to the 1970s, actually, because the Fed has guarded its monetary policy since then, because at the time, President Richard Nixon privately was pressuring his Fed chairman, Arthur Burns, to ease policy ahead of his election, because you're right, these political people think in terms of election years, and that pushed the U.S. into this punishing recession, and the early 1980s were just kind of a disaster. And so the Fed and a lot of central banks around the world kind of pushed for their operational autonomy, gaining the independence that they now have today. And a lot of investors look at Fed independence as a key ingredient to creating this environment to foster lower inflation, less risk, to bring investment into the country. It is the stabilizing force when it comes to U.S. markets. And so if that comes under much more fickle political power, then you don't have any of those benefits that an independent Fed has granted you.
Meanwhile, Powell is just in a pickle here. I mean, it's a really tough job he has here because he, in that speech on Wednesday, he warned that the tariffs were much greater than the worst case scenario that anybody at the Fed projected. So tariffs, he expects, will lead to higher than expected inflation and lower growth. And like, as you mentioned, I mean, that is just, those are clashing priorities because the Fed's has two mandates, which is to keep inflation low and employment high. Those are now clashing. He can't raise interest rates because that would send the economy into a recession. He can't lower them because he's also worried about the inflation. So there are these two competing priorities. He's not sure exactly which ones to prioritize. So we're in this moment of stasis where the Fed held interest rates at their current level for the first two meetings. And it looks like we're just in this wait and see approach because when you move one lever, it affects the other in a bad way, same vice versa. So Powell's just in this state of paralysis.
Powell's in a pickle. I like it. Netflix reported earnings yesterday, and it turns out you can't tariff love is blind. The biggest streamer in the world had another blowout quarter, posting a major earnings beat as revenue grew 13% in Q1 and surpassed $10.5 billion. As tariffs throw other sectors into turmoil, the streaming giant is looking like the calm in the macroeconomic storm. There's been no material change to our overall business outlook, the company said in a statement yesterday. Netflix is seen as well-positioned to ride out market turmoil thanks to minimal exposure to tariffs and an ad business that's driving steady growth. On top of that, analysts believe subscriptions to the service are among the last thing consumers would cut in a downturn because what's a recession without a little Black Mirror to calm the nerves? A slight wrinkle to yesterday's report. After ending last year with over 300 million subscribers, yesterday was the first quarter that Netflix did not report subscriber numbers. Netflix ditched the once important metric to focus on revenue and other financial metrics as performance indicators. So investors were happy to see its revenue and other financial metrics indicated very strong performance this quarter. Netflix certainly has some swagger to it right now. Executives shared the ambitious goal to reach a $1 trillion market cap and double its revenue by 2030. And $1 trillion sounds like a lot for a streaming company, but yesterday was a step in the right direction, Neil.
Netflix is coming off a record year last year. Revenue growth was 16%. Operating margins were up 27%. They got more subscribers last year than during COVID, 41 million compared to 36.6 million in 2020. So yes, the streaming wars are effectively over. Netflix has won. It's just this next act. That is an open question. A lot of it involves this ad tier, right? 43% of all new Netflix subscribers in February signed up to this lower priced ad tier, which is at $7.99 a month. And Netflix thinks that much of its subscriber growth and much of its revenue growth can come from advertising. You said it was recession-proof, but the ad market is not immune to a recession. MoffettNathanson projected that if a recession were to come, U.S. advertising spending could drop 5.8% this year. It had previously projected ad spending to grow 5.8%, so that's a huge shift from a big growth to a big loss. So we'll see if Netflix manages to weather the storm should it come.
It does think it's pretty well insulated when it comes to tariffs and a downturn. They, even at a March meeting, Netflix executives acknowledged the fact that the U.S. could enter an economic downturn, but they said that streaming could be less affected because people stay home, and instead of going out to the movies, they just post up on their couch and watch adolescents watch these big Netflix shows. Also, Netflix saw, this was a different circumstance, but rapid growth during the COVID-19 pandemic recession. That was literally because we couldn't leave our homes, but it is a little bit of a data point. And then you can go all the way back to the European Union's recession in 2012. International subscriber additions grew at a more rapid pace during that downturn. So there are some data points that do show that, yes, Netflix was a different business back then. It didn't have its advertising tier that is driving a lot of growth today. But there's something about just posting up on your couch, tossing on the TV when times are hard outside of your home that Netflix seems to benefit from. Up next, let's do our Stock of the Week, Dog of the Week.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to my favorite segment of the show, Stock of the Week, Dog of the Week, because it means it's Friday at long last. Toby and I will pick one stock that soared to space like Katy Perry and another that tumbled back to earth, also like Katy Perry 11 minutes later. I won the pre-show Who Cried More after Rory McIlroy won the Masters contest, so I get to go first. And my stock of the week is Hertz, because Bill Ackman just made a big bet on the yellow rental car company, and investors are loving it. The stock surged 56% on Wednesday after Ackman's Pershing Square hedge fund took a $46 million stake, equivalent to about 4% of Hertz's outstanding shares. Then yesterday, the stock added another 44%. Ackman is now the company's third largest shareholder. So what does he see in Hertz? The potential to upgrade from compact to full size, likely because of the auto tariffs. Trump's 25% tariffs on foreign cars are expected to raise prices for not only new cars, but used cars as well, since the two typically rise in tandem. That would increase the value of Hertz's vast fleet of used vehicles, which it could sell at a higher price point than before to reap the rewards. Of course, that's the bull case. There are plenty of haters of the stock, which is why nearly half of its float is sold short. Hertz has had a rough time finding stability after emerging from bankruptcy in 2021, when a huge investment in Teslas flopped hard, and a recession would probably kill demand for rentals. Toby, is Ackman a genius or out of his mind?
I guess we'll see. Basically, anything Hertz does is better than their decisions they made coming out of 2021, because this decision to go all in on electric vehicles was not the right choice. They placed an order for 100,000 Teslas. They wanted to remake their image. We're not a gas-guzzling rental fleet company anymore. We are this forward-looking, modern, environmentally friendly, tech-forward company. But the issue was renters kind of hate renting electric vehicles. One, it's that range anxiety. They don't know if they'll be able to fill them up. And then two, they were just difficult to maintain and didn't really hold their resale value that much. So it's very interesting, too, though, that they got bailed out by this very unlikely source of, President Trump's tariffs jacking up car prices. So I think that is where Ackman is seeing down the line. Is this a more healthy business now than it was, a few years ago? Maybe now that they're rolling back that electric vehicle pursuit. So just seeing the stock movement, though, that it's still got a little bit of that meme stock culture
flavor
to it, because this thing went straight up the past few days. So definitely some remnants of that, the heyday of its meme stock heights. My dog of the week is United Health Group, which sent shockwaves through the insurance industry with a gloomy annual forecast and its first earnings miss in over 10 years yesterday. The company said it was hit with some unforeseen rises in medical costs, which caused them to tear up their forecast they made just 3 months ago. Markets did not like the sound of that, and the company fell as much as 20% when markets opened, its biggest drop since 1999. United Health is the largest seller of Medicare health plans, which left it especially vulnerable to both an increased amount of care activity from people using those plans, as well as some payment changes the U.S. government made to crack down on some of the tactics insurers use to boost their profits. The disappointing results also stemmed from Optum Health, the company's clinic, surgery center, and home care division, which had previously been its fastest growing profit engine. United Health cut its 2025 revenue forecast for its once cash cow by around $10 billion. So, Neil, a historically bad day for United Health, one that also dragged down the rest of the Dow with it.
Right, a very curious outcome in the stock market, too. You might have checked your stocks yesterday or the major indexes and saw that the Dow was down over 1.3%, while the S&P 500 was up 0.1%. Usually those indexes go pretty much in lockstep with each other, so it's curious to see such a massive divergence, and that is specifically because of United Health. United Health is the highest weighted stock in the Dow, and we talked about this a lot. The Dow is a index of 30 companies that is not representative of the stock market because it is weighted by share price, not by market value. United Health has a share price of more than $400 per share, which means it is weighted more in the Dow than much more valuable companies like Apple or Nvidia. So whatever United Health does on any given day, that's typically what the Dow is going to do. So United Health dropping as much as 20% dragged down the Dow 527 points, which was more than it dropped in 1987 on Black Monday. So that is sort of the divergence you saw between the Dow and S&P. Blame United Health for this truly shocking earnings report. Investors were absolutely floored. The CEO said, I don't even know what's going on. Like we issue very conservative expectations and guidance going forward, and we completely whiffed on that, like a huge executional misstep. Finally, introducing a new segment to take you into the weekend we're calling Fast Food Fridays. This week, a number of chains introduced or teased new menu items that you simply must know about if you're a patriotic American. So here we go. First up, Chili's, which cannot stop itself from trolling McDonald's. On Tuesday, the chain rolled out a new burger called the Big QP, which is essentially a blatant ripoff of the McDonald's Quarter Pounder. It has the exact same toppings, 2 slices of American cheese, pickles, ketchup, and diced onions, but says it has 85% more beef. Chili's is leaning into the comparison with its marketing campaign, noting in a press release that its $10.99 burger deal is less expensive than the same one at McDonald's, and in a new TV ad called the Quarter Pounder Tiny. Bashing McDonald's while copying its menu items is a recipe that's been working really well for Chili's. In the most recent quarter, sales surged 31%, the third straight quarter of double-digit growth.
It's not the first McDonald's-inspired burger to even come out of Chili's recently, too. The Big QP is the second one. The first one was this Big Mac-esque burger called the Big Smasher that also kind of rolled out with this very pointed ad campaign that called out the Big Mac. So it is not shying away from these comparisons whatsoever. And the reason why Chili's feels emboldened to do this is, remember, McDonald's prices kind of have creeped upwards over the last few years as inflation started to impact consumers, and it actually has hurt McDonald's a lot, because now you're competing with someone like Chili's, someone like Chipotle, getting into that fast casual realm because your prices are no longer low enough that you feel like you're getting a good value. So it's very astute of Chili's to realize that, hey, this market leader is very vulnerable right now. Let's get after it. Let's release burgers called the Big QP. Let's put the exact same toppings on that McDonald's does, and let's call them out. And Chili's is just absolutely crushing it right now. The 31% growth. Its parent company, Brinker International, has seen its stock go up 200% over the past year. So Chili's is just undefeated right now. I'm feeling love in this Chili's tonight.
Even while getting stuffed into a marketing locker by Chili's, McDonald's is still going on offense. The fast food giant teased the long-awaited return of the snack wrap, a cult favorite menu item that hasn't been sold in the U.S. in 9 years. On Tuesday, the official McDonald's X account posted, quote, snack wraps 0x.14.2025, implying that the snack wraps would return on the 14th day of a month. That's still TBD. They sound like Gandalf, but it'll probably be before October, given the 0 as the first digit of the month. This isn't a total surprise because execs had previously said that the snack wrap would be coming back this year, but it's getting realer than ever.
The snack wrap is one of those weird menu items that has a massive cult following. I mean, we were speaking about it. We just have good memories of it. I used to eat 10 of them after soccer practice, but it was discontinued all the way back in 2016, which is wild to think about at this point, because it was just very time consuming to prepare. You had to steam the tortilla. You had to assemble multiple ingredients, which slowed down service times. And then also, despite what revisionist history might say, snack wraps didn't meet sales expectations at the time. So even though it is one of those things that people have been clamoring for almost a decade at this point, it wasn't exactly this big sales juggernaut. That being said, I think it's a great move to release it now. Chicken is having a moment again. Why not capitalize on people's love for this menu item as well? So I do think just the forces of people love chicken and people love snack wrap will kind of make this a pretty successful re-debut.
What's your pick on the month that it'll come back? So we know it's before October.
Yeah, I don't know if
I'll
it's
say
like
June.
Like a summer thing. Yeah, midsummer. Snack wraps in the summer sounds pretty good to me.
Let's snack wrap it up there. Thanks so much for starting your morning with us. Have a wonderful Friday and an even better weekend.
Great show today, Neil. I wish you all well.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is a podcast that will make you a smarter investor, period. And this episode is definitely going to make you a smarter investor. I want to welcome in for our feature interview Lindsay Hans and Eric Schimpf. They are co-heads of Merrill Wealth Management. Good to see you all here at the NASDAQ in Times Square. Appreciate it.
Yeah,
Great
good morning.
to be here, Brian.
Level set for us, of course, Merrill Wealth Management inside of Bank of America. How big is this business, Lindsay? Just let's get some numbers on the table here.
Sure. We have the privilege, Brian, of leading $3.6 trillion in client balances.
Trillion.
So with a T.
Okay.
We are spread out across 600 locations across the United States. We have thousands of financial advisors that lead those clients. So it's a large-scale firm, and we're growing.
What is it like having the responsibility to oversee $3.9 trillion?
Yeah, it's, well, first of all, good morning. It's a big business, as Lindsay said, and sometimes you look at it and you can say, wow, it's great. It's a great honor, it's a privilege. You know, Lindsay and I have, as she said, you know, we work with 28,000 fantastic teammates every single day who just look to care for their clients. And it's big, it's a fair amount of time on the road, as you would imagine. It's a great responsibility. But we work with just a great team of people.
So April, of course, has been a roller coaster for markets. Maybe that's putting it nicely. Mm-hmm. Bring us inside how your life has been so far. Where have you been? What are you hearing from clients? Because when I talk to investors, some of them are scared out of their minds. Others are looking for opportunities. When I talk to CEOs, same vibe. They want to put money to work building new plants, but they have told me operations and planning are in a state of chaos. How are you seeing things?
Yeah, I mean, well, first off, as we headed into the year, I think all of us knew we were a bit overdue for a correction. So in some ways, we were expecting something. You never know exactly how it's going to come, when it's going to come, and what the different dynamics are, as we know. But our advisors have made a career over helping clients through periods of volatility, and every period of volatility feels a little bit different. You know, this one a little bit different, you know, of course, but we work with clients in a way that tries very hard to prepare them. We're very anchored in financial planning, and when you're doing financial planning the right way, you're starting with a client of what's your risk tolerance, what's your time, your time horizon for liquidity, you know, what could go wrong here. And so when these things come, we feel that we've really prepared our clients. And you know, we also lately, especially the last month, have been talking to clients about things like the power of staying in the market. When you look at since January 1st, 2020, and you look at the 10 best days in the market since then, had you been out of the market in those 10 best days, you'd be down 33%. Being in the market for those days and all the time in between would have led you more like up 18%.
Maybe Warren Buffett's onto something.
Yeah.
I mean,
so,
I mean, he's a pretty smart dude.
We talk to clients about staying the course, right? And you know, we do listen to Warren Buffett as well. So
And as Lindsay was saying, you know, really grounded in a plan. And when there's bumps like this or things happen, and again, they're never predicted, you know, but they're due once in a while. It sort of puts that. It tests that plan a little bit to the foundation, right? Okay, we've talked about turbulence, we've talked about risk, we've talked about up and down side.
And I still hold this stock that's down 20%, down 5%, down 3%.
And then you have it, right? And so it's a great time to sort of maybe revisit some of those tenets. You know, what's the goals? What's my time horizon? What truly is the purpose of these funds? And sort of get grounded back in. And then I think the next steps are sort of easy then, right? You sort of say, okay, am I allocated properly? Where am I short? Where should I be looking to maybe add some things or make some changes?
I'm always interested in what folks such as yourself are hearing from clients. Mm-hmm. What are you hearing from your financial advisors? These folks are on the front lines, especially in this environment. What questions are they coming to you with? And what's your message been to them when they're on the phone with clients that might be scared out of their minds?
Yeah, I think we've heard a lot from financial advisors in some ways of, hey, we've been through this before and we will get through this. And again, this just validates our model in many ways, Brian, right? The power of having a human advisor sitting next to you the same side of the table, looking across at what's going on, whether that's in the world, that's in your portfolio, that's different solutions we have to figure out what you want to do. And that partnership and relationship becomes even more valuable in a market like this. So in many ways, advisors are feeling great because they're being proactive with their clients, they're helping their clients understand the guidance. I think this one may be a little different because our advisors have clients on both sides of the aisle, and in this environment, given what's going on, there's probably a bit more of a political conversation, maybe even before we get to the portfolio, and that's being initiated by clients.
Well, I'm glad you mentioned that. I'll stay with you on this one. Are Republicans investors, are they okay with the volatility and they're going to ride through? Because when I talk to investors that have voted for President Trump, they're like, he's going to bring back manufacturing. He's going to cut regulation. I'm okay if my stocks are down. I'm confident over the next 5 years, these stocks might be back up. Do you hear that from them?
It really varies client by client. You're probably going to get a bit more of that sentiment from clients on the Republican side of the aisle, but everyone's going to process this a little bit differently. Again, depends on where they are in their life, their portfolio. There's just a lot of emotion going on right now, as we know, so it's just going to depend on the client.
I thought robo-advisors were going to take over everything.
I don't think it would surprise you that the co-heads of Merrill Lynch believe the best advice is given by humans.
Not a shocker, guys.
At the kitchen table, right? And you asked Lindsay about, what are advisors thinking right now? How are they? It's just been great to watch them. I mean, they're at the kitchen table, they're on the telephone, they're just again grounding themselves and their clients back in this financial plan. The risk that you're taking, is it proper? What's the goal for your money? And being part of Bank of America, we just have access to information and access to data.
Mm-hmm.
One thing I would, Lindsay and I encourage people to, something called the Bank of America Institute. We have 70 million clients at Bank of America and customers, and we see that data, right? And we have real time, what are clients spending money? What are payrolls looking like? What are savings account balances looking like? And when you have 70 million data points, you just sort of get a real time, view as to what's going on. That then through the work, Chris Heisey and our research team, they take that data and they frame conversations for our advisors to have individually with clients, and it sort of helps with the pathway of a way forward.
One piece of research we read at Yahoo Finance from B of A is the fund manager survey, and the most recent one dropped and had a lot of cautiousness in this report. Do you see that cautiousness with clients that reflected that, that the report caught? I believe they just seemed very bearish on stocks.
Yeah, we saw that as well. When we look though at the peak volatility period earlier this month, as we were looking day to day, Thursday, Friday, Monday into Wednesday, our clients were actually net buyers during that period on the wealth management side, and particularly with ETFs. So we saw a lot of buying in ETFs. You saw some selling, but you saw more buying. We saw a lot more interest in our centrally managed portfolios that Chris Heisey and the team run, as well as our custom managed portfolios with several strong third-party managers that come in and provide that for our clients. So we did not see, and even later in the week, we did not see panic bond market selling. So again, we generally saw the power of this model of stay the course. And at the end of the day, we're going to get through this, and I'm going to go back to my plan as a client. And has anything changed for me in my plan? No. And then we're going to monitor. We like everybody, there's a lot of uncertainty as to what comes from here, and we've got to monitor. But generally, we did not see clients hitting the sell button across the board.
When clients are dipping their toe back into a market that is off its highs, what are their reasons for coming in here and buying, even knowing that the markets may turn on a dime because of one social media post?
I think it's grounded in this financial plan that Lindsay talked about. It's this idea of, I'm a big believer, the old adages of the markets work. Dollar cost averaging, having some dividend, having a well-diversified portfolio, buying on a regular basis. If you look back over time, Brian, those things work. And so it's looking for ideas. It's looking for, okay, where am I allocated toward my risk tolerance? Again, what are those goals? And then saying, okay, the things that we made a decision on 6 months ago, are those fundamentals still in place? Are the reasons why we made those decisions still the same? and now maybe we have an opportunity to add some things. And if you look at, our client balances, we have been net buyers over the last couple of weeks, as Lindsay said, but cash is there. I would say there's a fair amount of dry powder, if you look at that $3.6 trillion, and I think that's a couple reasons why. There's been an interest rate the last couple of years, so clients have been able to sort of have cash as an asset class again.
Cleaning up on my B of A CD.
There you go.
There you go. Thank you. Thanks, Brian Moynihan. Should I be thanking him? C of B of A? I don't know.
We'll
Maybe
tell
I thank the Treasury market.
We'll pass it on.
I think. I don't know.
But there's been a rate on cash for the first time in a while, and clients have taken advantage of that, and cash has become an asset class again. And I think that just gives clients an opportunity to say, okay, when the time is right, to think through it again with a time horizon. Most clients aren't invested for a day, right, or a week. What is that long-term goal?
Everybody wants to be long-term.
Yeah.
Until they get punched in the face and their stock is down.
But that's why I come back to my opening, the opening question you asked me is, markets like this test that resolve. They test the goal. Clients set to retire. Said, now you want to retire tomorrow? Or are we still talking about retiring 20 years from now? And I come back to Lindsay's comment of, days in the market matter.
True. All right, hang with us. We're going to go off for a quick break. We'll be right back on Opening Bid.
Oh yeah, you're not going to forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not going to forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not going to forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
We're having a great conversation with Lindsay Hans and Eric Schimpf, co-heads of Merrill Wealth Management. Hopefully, they are going to help you make lots of money in the market in this episode, and really all for free. You have to watch this. But anyway, I recently had a conversation with Treasury Secretary Scott Bessent, and he mentioned in terms of Treasuries maybe not being in a crisis. Where do you see the bond market headed?
Yeah, so we try to think about things, Brian, in the standpoint of scenarios, right? So, you know, when we look at the broader macro picture, our CIO team's base case scenario is actually one of still some moderate growth broadly, you know, in terms of earnings growth. You're going to get periods of choppy volatility here and there, but overall, that's actually our base case. We have a bear case scenario that speaks a bit more to your question. That's going to show, you know, flat to negative earnings growth. We're going to continue to see a pickup in bond yields, and things are going to be a bit more dire. Again, we've got to run the company in a way, as Brian Moynihan says often, that prepares for any and all environments. And we believe we set the company up that way, and we've got to be able to help clients through both of those different scenarios. So,
and we listened to your, you know, we saw your.
Thank you.
Listened to the interview.
Appreciate it. Much appreciated.
Yeah, and I think we would agree. He was a big proponent of financial literacy.
Yes.
And having conversations and working with advisors. I think he's exactly right. You know, and we talked a minute ago about sort of old adages. You know, things work. I think one of the things that really works, and we're both parents, is starting early and starting young. Right? What are first-time investors doing? What is that next generation doing to get started?
Hopefully they're buying their kids on video on the dip, guys. I mean, let's just be honest. Well, let me, before I go down the rabbit hole of that one, well, the other thing the Secretary mentioned to me is the tax plan. And he specifically said we might get clarity on the next Trump tax plan by July 4th. Yeah. Thought it was an interesting comment.
Yeah.
What are you hearing? But he did not rule out letting tax cuts potentially expire on the wealthy. Yeah. What are you hearing from clients right now? How are they preparing for a potential tax plan later this year?
Yeah, so much going on right now. You've got tariffs, you've got immigration policy, you've got the tax bill, you've got deregulation and the impact on multiple industries. I think any one of those alone is complicated. All of those together is quite complex, as you know, to try to predict and navigate. So, you know, we are waiting and watching like most in terms of how this is going to play out. You know, again, just trying to stay with clients and manage to what does this mean for you? You know, at the end of the day, staying the course. But there's quite a few uncertainties right there.
And the cycle's quick,
yes.
Right? And we often say, you know, what it could be versus really what it is. And it's a lot easier when we sort of know what it is.
Well, if these if taxes do go up on high-income earners, what changes do you anticipate them making to their portfolios?
Well, I think you know, tax advantage investing, whether it's a new tax plan that changes rates on the wealthy, has been a theme that has just been popping up even prior to this administration. I mean, it is one of the biggest themes that we hear people leaning into, whether it's tax rates. The market's had a pretty nice run the last couple of years, so embedded tax gains that people already have, and they're looking to transition their portfolio a little bit because risk might have changed, they might have achieved a goal. So we think, you know, having solutions that take really tax advantage investing at heart is really a big area of growth for us. And Nancy Fahmy, a wonderful teammate of ours that leads our investment solutions group, has really been active in sort of how do we provide solutions that help clients do that.
The cool thing with this podcast is that viewers and listeners get direct access to our guests. So they're getting direct access to you. Let's say someone has a $500,000 nest egg and they are retiring in 6 months, but they've seen a lot of their wealth evaporated or eviscerated in the past month. What did they do? What's their game plan?
And they're retiring in 6 months?
They retire in 6 months. They now have a $500,000 nest egg. Maybe it was at $750,000. Prices are going up for their everyday needs. What do they do?
Yeah, look, you know, every client, again, we keep going back to that. We do not have a one-size-fits-all approach to our clients. Each client's going to have their own risk tolerance and sensitivity and, you know, time horizon. But, you know, somebody that would be that close to retirement needs liquidity, needs to maximize liquidity in our view. So really, you know, be looking at things like how do I maximize yield on cash, to Eric's point. You know, cash is an asset class and there's now yield, and And so it would probably be more of that type of conversation with the client really being that close, and then thinking about fixed income, right, from the standpoint of being able to clip coupons. Again, you got to be thinking about what part of the fixed income market you want to be in. But we'd be in a more defensive posture with a client in that situation.
Yeah, I mean, Lindsay's dead on. I would come back to that asset allocation. I might even suggest, if someone knows they're 6 months out from retirement, it's not really a question for me of what's going to happen short term.
And this isn't for me, full and fair disclosure.
Right.
I'm not near for retirement. I'm not too young. Thank you. I appreciate it. Just want to level set.
There's no gray hairs.
But your scenario, right? Hey, someone's ready to retire in 6 months, and they've seen their portfolio go from $750,000 to $500,000. I wish they would have had a conversation 2 or 3 years ago saying, okay, how close are you ready to retirement? What is the risk that you're going to take? And yes, there's got to be some risk exposure there, because you're not going to hopefully live just 1 year in retirement, right? You're going to have a retirement that you enjoy, and you travel, and whatever's important to you, you do. But it's a broader discussion, so you're going to need some growth. But again, markets like this test the resilience of a financial plan, and was it built right? And that comes back to the power of working with an advisor and really just making sure it's tailored at an individual level for you.
In the last 2 minutes of the podcast, we always love to get our hot takes from guests. This one is, I'm a bit of a leadership buff.
Okay.
How does this work? Managing $3.9
We were waiting for you to ask that.
$3.9 trillion. 3.6 trillion with a T. Like, what are your strengths, and how do you combine them to run a business that shows up on B of A's earnings release in a very big way, guys?
Yeah. You can imagine we got that question a lot.
It was a popular one.
Especially in the beginning. But we looked at a couple things. In our years, combined 54 years of professional experience, lots of different geographies across the country, lots of different roles, and communication is really important in any job. It's important in any marriage, it's important in any team relationship at work, it's important in any role that you have. And so a co-head model and how we make this work is very anchored in how we communicate. And Eric has said sometimes, I'll steal the line, we start our day together on the phone or in person, depending on where we are in the country, and we end our day on the phone and a lot in between. And none of this works without the communication.
Yeah, it's been 2 years. We celebrated 2 years.
Yeah, I remember seeing the news.
Yeah.
It feels like yesterday.
And as Lindsay said, it was a very popular question when it happened. For me, and this happened within literally 30 seconds of us both knowing that we had this opportunity to do this together, grounded in immediate trust, that we know putting the best interest of our clients and our advisors and the people that we serve every day at the heart of every decision we make. You find sort of a calm and comfort in that. So, we have the best interest at heart. My day does start and ends with Lindsay. People sometimes ask us, do we disagree? Sure, you'll never know. But I think that's the power of, the old wives' tale, two heads better than one, and there's a tremendous amount of leverage.
Do you think this model could work more broadly across Wall Street? Or is there something unique to B of A?
Yeah, no, I actually am surprised it's not more common, and we could have our own theories as to why, but I mean, Eric's point on when you start from a place of, hey, like doing this together is going to give us diversity of thought and get us to better outcomes for clients and the people that we serve, and is going to get us scale, leadership at scale, because the efficiencies that come with being able to cover more ground when you're two people. And when you, as I mentioned at the beginning, we've got people across 600 locations across the country, and so we can be in a lot more places separately. And then the part we haven't talked about yet in this podcast, but we talk about often, is both of us are parents, as Eric mentioned. And so we subscribe to the view of not a work-life balance, impossible to have balance on anything, but it's work-life integration. And so, when you think about got something with my kid's school. No, I don't make everything at my kid's school, but the things that are important I do. Hey, the place is going to run without me. There's amazing leaders, but knowing that there's someone in the exact same job that I'm in, that has the judgment and has, we have full autonomy to be able to say to each other, you got this, I got this, we're going to make the decision and move on. In times where there's other things going on in life, is incredibly convenient and valuable and powerful for the people we lead in the industry to see that we each have two jobs. We are the presidents of Merrill, and we're also parents, and both matter. And you can't do both of those A+ every day, but we do prioritize both of those as best we can.
Well, I will say this to wrap this up. Hanging with you both for a while, I can see why this works. Like, there's just this one brain. I get it. I get it now more, and I feel you. It should be a model employed by more of these firms because these businesses, as you know, have gotten so
big and
humongous and very complex.
And it's out there, Brian. I'll tell you, when we were promoted and we got the job, you mysteriously hear from other co-heads in the industry, outside of the industry, that reach out to you and say,
You're the standard bearer.
That's right. And
for
so, I'm surprised more people don't do it as well.
All right. Well, hopefully they will after this episode. All right. Lindsay Hans and Eric Schimpf, co-heads of Merrill Wealth Management. Good to see you. Hang tough. These are busy times. Appreciate it.
You too, Brian.
Thanks,
Thank you so much.
Thank you so much.
Okay.
All right, and that's it for the latest episode of Opening Bid. Hit us with those thumbs up on YouTube. Love your comments. Always try to get to them. Love the hearts too on the podcast, on the platforms. Appreciate the love.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Welcome to Financial Freestyle. Hi, I'm Bob Howell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Yahoo Finance Sports Report.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Mag 7 stocks added more than $1.8 trillion in market cap value on Wednesday alone. It was a rip-off-your-face rally for the ages. So let's take a look at some of these record-breaking moves. I'm Jared Blickery, host of Stocks in Translation. First up, let's take a look at what has happened in these stocks this year. So we got 7 stocks, and I've divided the year into 3 parts, and they are definitely unequal. In blue, we have yesterday. That would be April 9th alone, that Wednesday, when we had some of the biggest market moves in history in some of these stocks. And then we also have from the February 19th top to April 8th, and that's that big down move. February 19th with the top in the S&P 500 and some of the other indices. And then in white, we have the year end of last year to February 18th, and that would just be up for some and down for some. In the S&P 500, it was a little bit of a rally. So looking at this chart, you can see that first part of the year into February 19th, that really wasn't much. It was just kind of a blip on the radar, these little white spots here, some up, some down. As I said, Meta was the best performer, had those 20 up days. But then when you look at the declines, those were substantial. Nvidia and Apple both saw declines well over $1 trillion over this time period. And you can see some of the gains are a little bit less, but even Amazon down $500 billion, nothing to sneeze at. And then if you focus on the blue, those blue bars, that's what happened yesterday. April 9th, and you can see Nvidia up $440 billion, Apple up $397 billion. The least bullish of these was Tesla, up $162 billion. Nothing to sneeze at here. And a lot of this corresponds to the top 10 days for the Mag 7 of all time. These are the biggest market cap gains single day in history, and Nvidia and Apple are right there. I already went over those 2 moves. In fact, everything in green is what happened yesterday. So 4 out of the top 10 moves in history occurred on April 9th. Now, I also took a look at the worst moves in history, the worst single-day moves. And it looks like 1, 2, 3, 4, 5, 6 of those out of the 10 happened this year alone. And that's everything in green that you're seeing. A lot of these happened very recently in April. You can see the biggest of these is a $300 billion decline by Apple on April 3rd, and then it also takes the number 2 spot down over $200 billion the next day on April 4th. You put it all together, it really validates the thesis and the common understanding among investment professionals that the volatility clusters, so some of the best days in history are usually right around some of the worst days in history, and whether or not you want to stick in the market and survive all that, that's a topic for another day. But tune into Stocks in Translation for more market decoding deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
In CarMax's most recent quarter, the company found used car prices rose on an annual basis for the first time in more than 2 years. The news comes as 25% tariffs are in effect on all U.S. auto imports and additional tariffs on parts. They pose a threat to vehicles made in the U.S. So where does that leave the used car market? That's the big question. Here with more, we've got David Underkoffler, Editor-in-Chief of AutoList, a car guru's company. Now, let's start simple, David. How have tariffs affected the car market so far?
Well, on the used side, it's actually a little early to tell. We're seeing some sort of a little bit of growth in used car prices the first quarter, but that really was not related to tariffs. So it's sort of a wait and see approach to see the impact. We are sort of forecasting at this point that there certainly will be an impact. Right now, it's between 10 and 15% in terms of prices on the used car market. But I think we're a few months away before we start seeing those impacts directly. And then on the new car side of things, you're definitely starting to see some tension there. We're still at a period where many of the vehicles, or nearly all the vehicles sitting on a dealer lot right now today, were vehicles that were brought into the country prior to tariffs. So again, it's still early, but I think you're seeing consumers certainly are starting to react and sort of head to the dealership, sort of sensing that there may be changes ahead of us.
You know, what is kind of the supply and demand equation looking like currently for used cars in your view?
Yeah, so it's sort of an interesting point right now because we are seeing late model used cars, right? Sort of the new used cars. There are actually fewer of those. And that's because we're still seeing kind of the residual impacts of the chip shortage from a few years ago, right? So at that time, there were fewer new cars coming into the market, and those would now be coming off leases. They're entering the used car market. So there are fewer of those. But net overall, there are more more used cars. So there's more quantity, but what we're seeing is that there's also less quality, right? So what your dollars may have gotten you, what $25,000 may have gotten you 2 years ago, you now are getting more miles in the car and an older car for the same money today. So that's sort of a result of inflation, interest rates, and sort of the used market itself. So it sort of depends on what type of used car you're looking for.
So as you were mentioning, it means that your dollar goes less far, perhaps, here.
Yeah.
So what are we seeing in terms of the propensity to spend and what consumers are willing to pay for, and where they're saying, you know what, maybe I'll just wait for as long as I can at this point?
Yeah, so we at Autolist, we've been surveying our car shoppers since the beginning of January about tariffs and sort of how that's affecting their decisions. And we're seeing a lot of people sort of saying, you know what, there's a lot of uncertainty right now. I'm going to sit on the sidelines and sort of wait and see. So there's almost double the number of people who are waiting and seeing versus the number of people who are actually saying, you know what, I'm going to go out and get a car right now because of the uncertainty. So we would say, or my perspective would be, look, it's sort of dance with the devil right now. If there's a particular vehicle you want and you're going to need a vehicle, a new or used, in the near future, it's probably better to act now because I can't imagine a scenario in which prices for new or used decline. So yeah, that's sort of the advice we're giving people at the moment.
How is demand for electric vehicles and hybrids compared to gas-powered or internal combustion engine cars?
Yeah, great question. So for pure electric vehicles, it's a really interesting time. Sales of new electric vehicles were up in the first quarter of this year. And part of that really had nothing to do with tariffs, but it was sort of related to the Trump administration. Many people are anticipating that Trump will change the federal incentives that were brought into place under the Inflation Reduction Act during Biden's administration. So consumers, Ford and General Motors had really good Q1s in terms of their electric vehicle sales. So I would imagine that that's going to continue into Q2. On the used side, I mean, it's a great time to get a used electric vehicle. You can get some really killer deals. Sort of the incentive pricing is sort of built into the lower pricing now. So, a lot of people, if you're looking for a third car, maybe you've got a teenager in the house or just a commuter car, right, to use during the week. I mean, $5,000, $10,000 can actually get you a pretty, accommodating all-electric car. It's pretty interesting.
All these things considered, I was taking a look at a survey that was published this morning from Allison Worldwide and a poll, and they had essentially come to some of the findings here that overall the consumer sentiment and pricing expectations, they ultimately kind of painted a worsening picture for both foreign and U.S. automakers. I wonder what the manufacturing picture looks like over this uncertain period and how that will eventually impact prices more long-term, even in the used car market, if some of these vehicles that are being produced now over this next 18-month stretch, say, are going to be more expensive, and how that factors into the pricing once they hit the used lots later on.
Yeah, I mean, the ripple effects from sort of everything we're experiencing right now and will likely experience in the next several months as a result of tariffs. I mean, these are ripple effects we're going to feel in the car industry for years. I mean, earlier I was just talking about still today we're seeing the impact of the chip shortage from several years ago affecting pricing and supply and demand on the used side of the market. So I think, yeah, this is something we're going to feel for a long time. And also it's worth making the point that not only are cars themselves facing tariffs right now, but so are car parts, right? So if you are a used car dealer, you're looking to recondition the car and turn around and sell it, your price is going up, so the consumer's price is also going to go up. So it's sort of at every stage, regardless of sort of whether you're new or used or what segment you're in, we're going to be affected by this and for potentially years. And again, that's sort of separate from what else Trump does and it chooses to do with regards to tariffs. It's sort of the situation right now has already created this effect.
David, just lastly, while we have you, is there a best position used car dealer right now among the CarMaxes, the Carvanas of the world who go out and purchase vehicles, put their money forward in order to know that they can get a margin on the other side of that sale?
Yeah, I mean, again, this is sort of an interesting time, right? Because you're taking a little bit of any company that's sort of acquiring a vehicle is taking a little bit of a gamble, right? You're carrying the interest on that vehicle while you own it before you can turn around and sell it. And as I was mentioning, if parts pricing is going up, it creates a little bit of volatility there. So it's riskier, right? Your margins are less sure than maybe they were even 6 months ago, when you could sort of bake in sort of, the pricing expectations and the profit margin expectations were more stable. So yeah, I mean, it's a lot of overhead that companies like that are carrying, and so, like I said, some volatility that I think they're going to have to negotiate, and that's really tricky. I wouldn't envy anyone in that position moving forward.
All right, David, you've retired. You've reminded me that I have to fix the chain on my bike when I get home. I appreciate that.
All right. Thank you, Brad.
Thanks.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Goldman Sachs topping first quarter expectations boosted by record equity trading revenue up 27% from a year earlier. Joining us now, David Ellison, Hennessy Funds Portfolio Manager. David, great to speak with you this morning. Talk to me about that trading revenue beat in equities, the best results we've seen since 2008. How did Goldman win to that degree?
Well, I think they've, I don't know exactly, but I think that, they're getting back to their core franchise. They drifted off there for a while trying to get into consumer finance. But I think now they're back to, in a sense, their core strengths. And I think they're hiring the right people and they're getting the results.
So with that in mind, as you think about what they're kind of classifying right now and what they're looking towards in this environment to really kind of pull the levers of their business that would best suit navigating what some of the other bank CEOs have talked about in foreseeable or considerable turbulence were the words that Jamie Dimon used when they reported earnings. How is Goldman positioned differently to navigate if they don't lean into such a heavy consumer product focus and instead rest on some of their laurels, such as trading, such as wealth management even, and how can that continue to kind of buoy the ship in this near term?
Well, I think historically, that's been their strength. So it's been, trading, investment banking, sales and trading, all those things. And that's been their strength. And I think they do it better than most everybody else. And I think that they'll be fine. I think the issue is sort of where the economy is going to go. And things have obviously changed a lot in the last, 30 days or so, or last 20 days, or maybe the last 2 hours. But I think these are the types of companies, Goldman is a good example of a company that will adapt. I don't know exactly how, but, I've adapted to the business that I'm in. It has changed over the years and they'll do the same. And I think that, recessions are not bad for them. Recoveries aren't bad for them if they manage it right. So I think you get back to sort of what do you want to buy in this environment?
Yeah.
You buy well-run companies and let them figure it out and let them do the hard work to get to the other side.
And just some context for our audience, we've been reporting on how a growth area for Goldman moving forward is their wealth management business. Executives have been pointing to that as a growth area over the past several quarters. I do want to point out, though, something that David Solomon, Goldman Sachs CEO, said here, saying that we are entering the second quarter with a markedly different operating environment than earlier this year. That came in the statement this morning. What do you make of him avoiding the big T word there and instead talking about this as just a markedly different environment?
Well, I guess it's, it may be, the politically correct thing to do, but I think it's, it's more than tariffs. It's, it's what's going to happen to the labor pool in the United States, what's going to happen to the M&A activity that he's going to see or be allowed to do, let's say in the banking industry or all the other industries that are sort of being deregulated. So there's a lot of other things happening and that are unrelated to tariffs. Tariff seems to be the thing that everybody's talking about now. But I think the issue now is, things are a lot different. So the question is, how are you going to adapt to that? So I'm not, I'm not trying to be, the guy that thinks, that everything's going to be great. But I think the companies will adapt and they'll adjust. And I think our job as PMs and as analysts is to try to figure out which companies are going to be willing to do that and make the adjustments and hang on and see what happens.
David, thanks for taking the time here this morning. Appreciate it.
You're welcome.
Well, Netflix reporting first quarter earnings after the close on Thursday. Company announcing it will stop disclosing subscriber numbers this quarter, leaving investors looking for other indicators for the company's performance. For more, we're bringing in now Alicia Reese. She's Vice President of Equity Research at Wedbush Securities. Alicia, great to see you. So Netflix earnings on deck, Alicia. What are you telling clients? What should they expect?
Well, we were a little concerned going into the quarter given the pretty significant price increases across the subscription tiers. But at the end of the quarter, we conducted our quarterly consumer survey, which showed that there was very little attrition on the service, very little churn, a lot of people still intending to come back to the service in the second quarter. our fourth quarter survey before the price increases had indicated quite a few people coming back to the service after not having it for a while. I think just on content, this last year, Netflix gained so many subscribers, 15% in the first half, 16% in the second half. And on that, the viewership didn't go up very meaningfully. I think that was just because of the lack of content. So when you see that content really becoming a far more robust in 2025, and those price increases, that should keep a lot of those new subscribers and return subscribers on the service. I think overall it's pretty positive, but we have to remember that Netflix isn't going to be giving us subscriber numbers or the average revenue per member, so it's going to be a little bit trickier to determine where the stock is going to go once they report. But overall, I think it'll be positive.
Alicia, I'm so glad you just mentioned that, because I can't help but feel when a company changes its metrics or stops reporting certain metrics, it's kind of like when a restaurant changes up its menu or when a company changes its name. What they're basically saying is something isn't going the way we'd like it and we need to reinvent. Am I being too harsh here?
I don't know if it's harsh, but I think what the reason that they're doing that is because in 2024 they were able to add so many subscribers because of the password sharing crackdown and because of the subscription or the advertising tier, which was much lower cost. So it was a lot easier to keep those members on the service versus them churning out because they want to save a buck or two for a few months. So now in 2025 they have a very different focus, and that is keeping subscribers on the service and raising price. And all their testing suggests that they could do this, that they could keep people on the service, and that's largely due to the content spend, the content quality becoming a lot more robust in 2025. After last year, we saw the SAG-AFTRA strikes that really impacted the quality of content available in the market. And Netflix is just so profitable. They have so much more money to put into that content versus their peers. So they're also adding live content like the WWE. And so they have a lot to offer. And I think they can raise that price. And our survey indicates that they saw little churn in the quarter because of that.
Alicia, I'm curious, if there was a material economic slowdown in the U.S., Alicia, what could that mean for Netflix?
Well, typically what we see, especially following the movies, is that people will cut travel, they'll cut expensive purchases, and they'll stay home a bit more. For Netflix, that's great. The more people are home, the more they're going to seek in-home entertainment or perhaps going out to the movies. So that really benefits Netflix. On the other side, they're trying to grow their advertising model, and if they don't have advertisers spending as much, culling their budgets, that might impact the advertising tier growth for them and the revenue that they can derive from that.
Alicia, I'm curious, any new super hot hits coming out of Netflix? I think about Drive to Survive, which completely changed the trajectory of F1. Changed my trajectory too. I now go to F1 races. Yeah. Is there a next super show that's coming up, or maybe even a couple of them?
Well, I think Netflix is, I think we are going to see the benefit, not for Netflix, but for the movies in general, F1 coming out this summer. I think that's going to be a big hit. F1 is up for grabs, it sounds like, and there are a couple other sports properties that are up for grabs. So Netflix might make some, waves by purchasing some more sports content, some more live content after the WWE. But just the content that's coming out right now, there are quite a few really good shows. Frankly, they have to compete with some other big properties out there like The Last of Us. But so far, they have some really good breadth and depth and live content quality. So it's really just the balance of that where they have something for everyone right now.
Alicia, final question here. Looking at the stock, it is up nearly 55% over the past 12 months. Alicia, how do you think about valuation for this one?
Yeah, the valuation is a little bit trickier now because they're not getting the subscriber numbers. And so it's just a basis of revenue growth capabilities, and they have to beat that revenue guidance by quite a large margin now, I think, because they're not giving subscribers. And what investors want to see is just expansion of that free cash flow. So if you're expanding that free cash flow pretty meaningfully, the shares could continue to go up. It's been a little bumpy as through the beginning of the year because of these reasons, because people aren't sure as much what to expect. But I think they can continue to expand as long as that free cash flow continues to expand.
Alicia, great to have you on the show today. Thanks so much for your time.
My pleasure. Thanks for having me.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Johnson & Johnson topped the street's expectations in its latest quarter thanks to strong cancer drug sales during the 3-month period. The company boosted its full-year sales outlook, but tempered expectations for its adjusted operational profit, citing the impact of a recent acquisition and, of course, tariffs. President Trump has warned that levies will be placed on the sector very soon. Joining us now to discuss, Asad Haider, Goldman Sachs Global Investment Research Head of the Healthcare Business Unit. Asad, great to speak with you. Let's start on Johnson & Johnson maintaining the EPS outlook. How were they able to do that in your view, and what are your other big takeaways?
Yeah, thanks for having me. So there were some questions. I mean, overall, we thought that the quarter was actually very encouraging and very much in line with the thesis that we have on Johnson & Johnson. And just to zoom out for a second, we upgraded the stock to buy last week based on our view that the innovative medicine business is going to continue to surprise on the upside and show encouraging trends. And that's really what you saw. Now, there was some gross margin related pressure, which they cited, they attributed to Part D dynamics. This is the first quarter that the pharma industry is going to see some headwinds from the Inflation Reduction Act, particularly related to Part D. And there were also some tariff related costs that they talked about $400 million that they attributed to the medtech business. But beneath the hood, the pharma business did really well, and their operating margins actually beat because they flexed the P&L via cutting costs and cutting R&D. And to us, that was actually a very encouraging sign. And I think the combination of those things, along with a little bit of an FX tailwind, had them maintain the earnings for the year.
And how are you thinking about the impact of tariffs both on Johnson & Johnson and then just moving forward, because they are the first pharma name to report? What does what did their results tell you about how the rest of the industry might be impacted by tariffs as well?
Well, the short answer is not much. And I think it's still all very uncertain. I think we all have been waiting to see what the announcement for tariffs is. I think what's known, of course, is that the pharmaceutical industry is going to be tariffed the way semiconductors and autos and several other industries are. We've been waiting for this for a while. What we also know is that there has already been a Section 232 investigation that has begun. And depending on on how that goes, what we're all going to be waiting for is to see what level of tariffs are going to be applied to the industry. And at this point, I just don't think we have a lot of clarity on any of that. And so what that's been doing is creating a lot of uncertainty across the entire pharmaceutical sector. It's making people question the traditional orthodoxy around the margin structure and the profitability of this sector. But we just don't know a lot right now, and I think it would be too early for me to speculate on where this all lands. But this is a cloud that that it's an overhang on the sector, and until we get a real off-ramp, it's going to be hard to see how that how that overhang goes away.
And Assad, my guest host John Hilsenrath is still with me. John, you got a question for Assad?
Assad, you talk about J&J flexing their earnings muscle by cutting cost and cutting R&D. I'm listening to hear how all of this affects the economy, and that sounds like bad news to me.
Well, I don't think it's bad news necessarily. I mean, I think we don't really know line items on what exactly they did on the SG&A and the R&D side. I think it just speaks a little bit to the leverage that they have across the P&L to make these types of investments. I think what's more interesting is just the way that Johnson & Johnson has been responding, as I expect others to these tariff threats, which is building infrastructure, manufacturing facilities in the U.S. I think everyone saw that about 3 weeks ago they announced a $55 billion manufacturing commitment to the U.S. That is higher. That's about 25% higher than what they had initially said they'd do. They opened a new facility in North Carolina, which they are going to use to manufacture in the U.S. And there's 3 other facilities that they're going to bring on the manufacturing side that are yet to come. So I think those types of measures are probably more important for as far as the overall economy goes than these pharma companies really flexing the P&L in there with things like SG&A and R&D.
Shares of United Airlines are rising as the company tops first quarter earnings expectations, provides insights into guidance amid macroeconomic uncertainty. Third Bridge Global Head of Sector Analysis Peter McNally joins us now with a closer look at first quarter results for United Airlines. Peter, it is great to have you on the show. I'm just looking, this stock is ripping here in the after hours, Peter. It's up about 6.5%, but let me get your take, your response to the report and the results, Peter.
Well, I think there's a couple things to keep in mind here is, number one, expectations were set pretty low at this point. Estimates have been coming down for a month, started by Delta's pre-announcement in the middle of March. But the second thing is that, United sort of put a stake in the ground here in a recession scenario. Their earnings estimates will be $7 to $9 a share. So, and that would be with a 5% decline in revenue. And they're not sitting back. They're cutting 4% of capacity starting at mid-year, adding on to what they've already done as we've seen a slowdown in demand for air travel. And so the big picture is it's still a pretty profitable airline, despite some of the headwinds that have emerged here in the first 3.5 months of the year.
Peter, Simeon Hyman, is that fair to extrapolate that to the sector? You think of airlines as quite cyclical and not being able to do that well in a recession. So they're saying it won't be that bad. Can we extrapolate it?
I would not, Simeon. Look, the one thing about United is that they've always been investing for growth. And so they're taking even more planes that are more efficient and allow for more premium seating, and that's where the money is made. And then the real distinguishing factor for Delta, United, and to a lesser extent American, is their loyalty programs that have been a great competitive advantage, and that's going to add to earnings. These smaller regional airlines and the low-cost carriers are finding it more difficult to compete because they got smaller fleets, okay, and they're dependent also on Boeing delivering new planes or and some more competitive routes. And it's more difficult for them. So I think United's a standout. They've been investing aggressively for years, like in this fleet, and at times it's made people nervous. But at the end of the day, it's always worked out for them. So that's why I don't think I would extrapolate this to the rest of the industry just yet.
Peter, fuel costs have been coming down here. What does that mean for United and the broader sector?
I mean, it has certainly helped. But the one thing about it is that it helps all the airlines equally. Nobody really has an advantage when it comes to that. I mean, Delta to a small degree in that they own a small refinery outside Philadelphia, but it doesn't offset the hedges or create that much of a hedge for them. It's just certainly allowing a cushion as revenues fall or revenue expectations fall with this demand weakness we've been seeing lately.
Has there been a change in the hedging protocol? Because we used to get surprised back in the day. The oil prices would come down, and then these guys would come out and say, well, we locked in for the next 18 months, so it doesn't make a darn bit of difference. Has that changed in the last 10 years or so?
I mean, there's been less of it. I mean, look, oil's been fairly volatile in recent years, and you're buying insurance, right? And that insurance has gotten more expensive. The more levered companies, with weaker balance sheets have been forced at times to lock in those prices. But the Deltas and the Uniteds of the world, it's not making that much of a difference.
Peter, the earnings calls tomorrow morning. If you had the chance, ask the CEO a question or two, what would be top of mind for you?
The slight changes in the CapEx plan. They've dialed it down a bit. This is the second year in a row where they've walked it back. So what actually gets United to go all out for the 2026 plan that they've had what they need to see in order to push ahead with those investments to invest in the new aircraft?
Final question, Pete. I want to switch gears here a bit because you know this company as well, Boeing. Bloomberg did report China has ordered its airlines, Peter, not to take any further deliveries of Boeing jets. It sounds like what we have here is just this tit for tat and a trade war, Peter. I'm just curious what you made of that headline. What did you make that news? What did it mean for Boeing investors?
Boeing has 130 planes on order with China of the 6,400 in total in their unfilled backlog. It's not that big of a deal on that news, just itself. And it's not like China can go anywhere else. It's, Airbus doesn't have a whole bunch of planes sitting waiting either, but I think it's just kind of more noise when it comes to Boeing financially than anything else.
All right, we're going to leave it there. Peter, as always, thank you for that instant analysis and insight, my friend. We appreciate it.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
President Trump weighing a possible delay to auto tariffs. But as of now, there is a 25% tariff on all imported cars, with a 25% tariff expected to take effect no later than May 3rd on car parts. Let's go now live to the New York International Auto Show, where senior autos reporter Pras Subramanian standing by with Hyundai Motor America COO Claudia Marquez. Pras, take it away.
Yeah, Brett, thanks for that. Yeah, you know, that's the word of the day, right? Tariffs at the auto show everywhere we go, but also new cars here at the New York Auto Show. Claudia, thank you for joining us. Really appreciate it. So before we get into the new Palisade, which is right behind us, Brad talking about tariffs, sort of what everyone's talking about these days, the President Trump sort of focus on the auto industry. What's sort of Hyundai's position on that right now from where you're seated?
Of course, our position will always be we have to take care about our customers. It's a tough situation, yes, because there is a lot of uncertainty. But first of all, I want to share, and I'm sure that you know, but obviously for the audience, Hyundai has been in the U.S. for the past 40 years. We have a strong representation in the U.S. We have a factory in Alabama, and just recently, 2 weeks ago, we opened our new Meta plant in Savannah, Georgia, where we produce our EVs, Ioniq 5 and Ioniq 9. Just to give you perspective on that, 2024, we sold 836,000 units, and about 40% of the vehicles were produced in the U.S. So we are very confident on the market. Of course, the U.S. is very important for us. We're fully committed to localization. We understand, of course, the need for investment in the U.S., and we are playing a part of that. Now, when it comes to the customers, which again is tough, and even for us, just for planning purposes, what we wanted to make sure is that we have a plan for our customers. So we launched our Hyundai Assurance Program, which is confirming and assuring to the customers that MSRPs are not going to go up, in this, at least this couple of months. So we are very good in uncertainty. We call it the Hyundai Speed. And we're doing, and we're very prepared to deal with this reality, and again, always committed to the U.S.
Right, so you know, it's a day-by-day, month-by-month plan.
Sometimes hour by hour.
Hour by hour.
Yes.
And you're planning to, right now, you know, protect your consumers. So I think looking more long-term, part of the Hyundai toolkit, I believe, is investing in America with the Meta plant, building here. Is that sort of the toolkit you guys have? Is that sort of what you guys have been leaning into, even though that's years, it's billions of dollars of investment?
Hey, I mean, we're talking about tariffs, and all of this started in the beginning of 2025. I just want to share as well that it's not only that we have been with a factory here, but in 2019, the company confirmed an investment over $12 billion, which is a part of the Savannah plant that we just inaugurated a couple of weeks ago. I mean, really building a factory takes at best 3 years. Hyundai did that in a little bit shorter time. But that's all in all to say that, I mean, it's not about tariffs why Hyundai Motor Group is investing in the U.S. The U.S. is a very important market, it's the most important market, and we are here to stay for the long run and to invest in the U.S.
So speaking of that U.S. market, you know, the SUVs kind of run the roost here, and the Palisade behind us is the newest one from Hyundai. Talk to us about what changes were made to this new vehicle in response to the U.S. market.
Today we just left the press conference revealing the new Palisades, which I'm extremely happy and proud about. So the 2026 Palisades is our second generation. One of the things I am happier on many others is that for the first time we're going to have a hybrid, also as powertrain. The current generation was only available on ICE. Aside of that, of course, you can see a very bold, attractive, great design. We also are introducing with a different design Palisades XRT Pro, which also was presented in here. Safety, which is extremely important for the company, always under the promise of our brand promise, is amazing. Right. So design, safety, technology,
hybrid,
powertrain, exactly.
So, you know, I know hybrids are, we get that a lot of interest there in Yahoo Finance, people talk about that, but also EVs, the Ioniqs, at Hyundai have been doing quite well here, right? In particular, Ioniq 5 has been a hot seller. What's the game plan there for EVs? You know, we have the hybrid game plan here with the Palisade.
Yeah.
What's next for EVs, and how do you accentuate what you already have with the?
So, you know, I mean, Hyundai will continues really in a long term the EV strategy. Again, Ioniq 5, Ioniq 9 being produced in the U.S. What is going on today, of course, is in a little bit slower adoption for some of the customers. What we're doing, of course, is offering hybrid, as we were talking, which is like the short term until customers are actually convinced. But just to give you statistics on this March, for example, which was our last month, the last month we closed, we had our best ever March and the second best ever month since the launch of Hyundai in the US. And out of that, 72% of the volume in March were hybrids, and year on year, and 38% were EVs. So we're here to stay with EVs, and extremely happy about performance, design, availability. Ioniq 9 is going to be launched soon enough. Coming back to Palisades, we're going to launch in summer the ICE version, in fall the hybrid version. So many positive news in front of us.
So building the U.S. electrified powertrains, new products, and price protecting customers for now.
That's
Claudia
right.
Marquez.